All right. Hello, everybody. Welcome back to another episode of the Market Close. We are starting early today because we will have the one and only Tom Lee on the show in about 5 minutes. We got Evan right there in the chat. I'll be live with Evan on Twitter or X Spaces, so it'll be streaming it live through X on YouTube. Markets are still ugly today. We got a lot of market analysis to come after we get through the Tom Lee interview, which should be done in the next 30 minutes, so 3 to 3:30. And then we'll take a look at all these other stocks and what's happening here. The S&P 500 still down 4% on the day. It, I guess you could say, was at its lowest at 539.58 about an hour ago. Right now at 541. Qs are down 4.6%. The cruise line still down 10%. Amazon down 8%. Apple down 9%. Nvidia down 6%. Nvidia, I don't want to say bottomed, but it was at its lowest at 102.01. Now it's at 103. Obviously, still a very, very disgusting day across the board. However, a lot of stocks are still not as low as they were back on March 13th. So we're going to go through a lot of different analyses in terms of what's happening right here, the trajectory of the perception of these tariffs. We do have some updates from Trump. He did talk to reporters today. I don't know where he talked to reporters or how he talked to reporters, but there were some reporters that got some quotes from Trump. I don't know if he's on Air Force One or something, but we'll talk about his thoughts on the market's reaction. And we'll try to analyze what the heck's going on in the context of tariffs. In terms of Tom Lee, he hasn't spoken publicly yet since yesterday's announcements by Trump. So definitely very curious to get his thoughts on what's going on with the broader equity markets, what he thinks about the sort of face-ripping V-shaped rally he said that would be led by Tesla. Does he still have that same thought process? Does he think that the tariffs are going to be essentially like momentary tariffs in time, which is what I think a lot of the market is thinking of right now. If you look at some of these speculative names, the fact that Archer is down 2% on the day. Okay, now it's down 3%, but it was down almost 1.5% earlier. I mean, like this stock should be down like 20%, 30%. You know, these speculative names with zero earnings, if tariffs are going to be as bad as they are, should be down a lot more, and they're not. And so that's one thing that's encouraging today. I know that's not like the most brightest of the lines that are out there, but it goes to show maybe the market is thinking, hey, these are not actually going to be implemented. And I'd be very curious to see what Tom Lee thinks about that as well. And so we'll get his thoughts on that once he joins live. I did buy the dip. I bought Nvidia, Robinhood, Grab, and Google. Usual suspects, nothing too crazy. At the end of the day, I'm a long-term investor. Most of you guys are long-term investors, and on down days of negative 10% across the board, yeah, you tend to nibble at that dip. So, all right, I'm pulling up the spaces right now. There's going to be a little bit of a delay between the space and YouTube, but overall, you should be able to hear everything totally fine. Let me know if the audio does not work. But let me share it right here and we will get started. All right, so this is the spaces. I'll be talking through my phone, so you guys will see my lips moving, even though I'll be muted here. And we'll keep going from there. Okay.
All right, what is up, everybody? Unfortunately, I had a full reminder link ready to go, but it ended up not working. So I'm just going to spam this out a bunch to everybody, and I'm making sure to send this over to their team. So give me a second, hang with me on this one. But Wolf, we got you up here?
Yes, sir. Ready to go.
Okay, so let me send this over to them if you want to get us started here. Just talk a little bit.
Sure
We should
thing.
be having get everyone going here. I'm excited for this chat, though.
Yeah, absolutely. What a day in the market to be having Tom Lee come on. Of course, we got absolutely shocked with the reaction coming from yesterday. SPY is down 4% today. Amit, when was SPY's last 4% down day?
Hey, everybody. Thanks for having me. Super excited to talk to Tom Lee. Well, I think the last time we had a 4% down day on the SPY was September 6th, 2024. But the last time we closed down 4% was October 2022. So it's been a while.
Yeah, it's definitely been a minute. SPY not really getting much of a bounce here. It was at one point down about 4.23. It's down 4.11, sticking around the lows of the day. Tech getting absolutely slaughtered as well. QQQ was down over 5% at one point. It is now down 4.58%. So absolutely getting hit pretty hard right here. And there's a couple things that are holding up okay. I actually saw a few names which are standing out to me. Don't know if anyone was watching, but waste management, it's death taxes and waste management apparently up 1.15% today for new all-time highs at the moment. It just doesn't seem to care at all. I did notice that BABA was green this morning as well. Right around coming out of market open, it's slightly red now, so not too crazy. But yeah, things are looking really interesting on this morning. We're going to get some research pinned up from Tom Lee as well. Evan, are you putting that from your account to pin up?
Yeah, I'll go in and do that.
Okay,
Honestly,
awesome.
I'm just frankly sending out all the DMs because that other link didn't end up working. Classic X. So
Classic
hopefully we have him
X.
joining in a second.
Yeah, I had a feeling that might happen, to be honest. It was kind of in the gut, but you never know. You just got to keep rolling with the punches. I think we're going to get a great audience, almost 1,000 people in here already anyways. So while he's doing that, again, the research is going to be going up top. We were going to talk a little bit about the Granny ETF that he's got that's been out for a little bit now, I believe, GRNY. That is the Fundstrat Granny Shots US Large Cap ETF, which is, feeling the market today like the others, right? Down 5.5%, but what's not down right now. But I think we're going to go more into like general research as well as some tariff talk on here today instead. Amit, what was your morning stream like today? What did you hit on?
Well, it was a pretty crazy morning just because I don't think we've had this type of a day in 2025 yet. One stock that is green is Clorox, and I know some people might feel like drinking bleach right now, but like I guess the market thinks that demand for bleach is not going away anytime soon. It is really interesting to see that the rotation out of tech has been the most aggressive in 2025, and that's something I think a lot of people definitely didn't think would happen. I know there were some people saying, all right, we're going to get a rotation into small caps and mid caps. And to an extent that has happened, not really small caps, but consumer staples, defensives, etc. But Clorox trades at 19 times earnings and Google trades at 17 times. So it is a wonky market right now. And obviously these tariffs are having a big impact on these valuations.
All right, we got Tom up, finally. My bad, X having the mistakes. Tom, I think we got you up here.
Yes, can you hear me?
Yes, we got you. Awesome. I'm very excited for this conversation, Tom. We really appreciate you joining us up here. I know that you have so many fans on X. We got a bunch of people tuning in. And I hope a lot of the people who are also, signed up for your research too, which we will talk a little bit about there. If you guys didn't know, Tom also has a 30-day free trial we'll talk about going forward. But Tom, I appreciate you joining us up here. How are you doing today? There's obviously a lot of craziness going on in the market right now. Yesterday, we got hit with Liberation Day. A lot of announcements around, the Trump tariffs. And there's questions around, are these just the initial, just bow, just throwing what's out there? Is this just the start of negotiations? You would think that maybe we would have seen some headlines coming out today, and we see some Trump comments over the last hour, so maybe there's some more expected. But I think the market is dealing with a lot of uncertainty right now, and I just wanted to get your opinions on what we saw yesterday and how you're approaching the next couple of days and maybe even the next couple of weeks as well. I appreciate you joining us.
Yeah. Well, yeah, thanks for having me. Today's the day after Tariff Liberation Day. Tariff Liberation Day, the outcome was worse than expected because I think markets were bracing for, maybe some sort of simplified, but nothing punitive. And then the rates that were announced and the reciprocal were far greater than many expected. So I think today, is not surprisingly a day where the market is now absorbing the shock. And, couple quick thoughts just on what the market's doing. We had an opening gap down 3.5%. And from that gap, I mean, we're a little bit lower, but stocks have basically been at the same level. So in a way, I'm not sure I want to characterize it this way, but it's kind of been an orderly sell-off, even though it's been huge. And I think investors then have to sort of, over the next couple of days, process a few things, right? Because the first thing that we know is the tariffs don't really start till April 9th, which is a week from now. The 10% starts on the 5th, but really these much more elevated rates don't start for a week. And the White House has been pretty much silent, right? There was no press, there was no White House briefing today. President Trump made 5 seconds of comments today before he got on a helicopter. And so the only voice we really heard from today is Secretary of Commerce Howard Lutnick, who has basically said, we're not going to talk to anybody, and actions speak louder than words. And so I think it's a clear signal to me that the White House wants all these other countries to be caught up in essentially a panic and chaos until April 9th. And then at that point, and this is just my guess, but at maximum pain is when the White House actually then says, okay, let's make a deal. So the stock market, of course, has to sort of process this over the next week or so. Um, I I'm not in the camp that I think there's a lot of downside from today. And let me just share you a couple of thoughts. And of course, then we could sort of, have a discussion again. But the first is, I think as we're looking through this these these new sort of exempted items, and Goldman Sachs put this together, the effective rate of the tariffs is 12.6%, and for all the countries, and on $3.2 trillion of imports. Now, while that number sounds huge, um, it is basically in line with what many thought was the worst case scenario, which is around 15%. And the second thing I think people should keep in mind is that uh, it's really only 6 or 7 countries that really matter. I mean, there were like 100 countries named, and I know people are probably up in arms because there's all these like random countries that suddenly seem to have like penalty rates for their products. But at the end of the day, more than 70% of U.S. imports just come from six places: the EU, Mexico, China, Canada, Japan, and South Korea, Vietnam. In fact, maybe the best way to put it is like there's Mexico, Canada, then there's the EU, and then there's China, and then there's a block of countries, which is Japan, South Korea, Vietnam. And I would say, looking at those countries, I think the U.S. is going to do something with Canada, Mexico. I mean, they're exempted from these penalty tariffs anyway, so that it's whatever's going to happen with the USMCA. And with Japan, South Korea, Vietnam, they're essentially allies of the U.S. I don't think that they want to foment a new trade war. But of course, Japan, Korea, and China, we're talking about a tech supply chain, so I think that's going out the window. But I think it's not going to be a problem to sort of come to some agreement there. And those countries can either choose to negotiate or retaliate or do nothing. And of course, I would expect them not to retaliate, but to either negotiate or do nothing. And of course, I'm sure they're going to negotiate. So really, the two regions that are going to be at the center of this is just the EU and China. I mean, I would say that's the only thing that anyone should really be watching. And the EU, I think, at the moment is beating its chest and saying that they're going to be taking retaliatory actions if the US doesn't negotiate. And that's what I think is going to be dominating headlines until April 9th. And similarly, China, of course, is going to seek to do the same, but China and the US have other things to negotiate as well. So China's hand isn't that weak because, one, China, number one, is a huge supplier to the US. Two, China, there are a couple of deals that kind of matter at the moment. One is TikTok and one is the canals, the Panama Canal. And the third is that if the US is going to try to do any onshoring, they're going to need a lot of robots. And the country that's making like all the robots is China. So I think that China and the U.S. China's not going to just not do anything with a 70% tariff rate that they're sitting on, or effectively, I think the math works out with the exclusions like 47% for China. And as far as the EU goes, that's $600 billion of imports. It's $120 billion of tariffs. I'm just gonna point something out. All right, so I'm kind of like eliminating all this. So I don't think I don't think we're gonna have like a trade war from Japan, South Korea, Vietnam. I think Canada, Mexico, we're gonna figure it out. And China, of course, actually China does have cards. So the question is, if Europe, the EU has $600 billion of imports, and that's really where this is going to be a high stakes game, and the tariff is either 10% or 20. So it's $60 billion. Does $60 billion justify taking $2 trillion out of the stock market today? I mean, that would be my first cut on why I think, even though it feels like there's a lot of bad news in front of us, at the end of the day, I actually think the U.S. is going to come out fine. And the second thing I would just point out, I guess, because you might get really, you might be very concerned, but, for every 10 basis points that the 10-year yield drops, okay, and I'm kind of oversimplifying this, but it's basically $36 billion less of debt service for the U.S. So if in yields, have dropped more than 100 basis points. So, we've already essentially cut out $360 billion out of, the U.S. debt service. So you're already, recapturing, because of lower interest rates, what you might even think is a burden to households coming, because of course, U.S. households benefit from lower interest rates as well. So I'd probably just say, I can't tell you that April 9th is going to be like the day of negotiations, but to me, I'd be very surprised if we don't see it by April 9th. A bunch of countries, and remember, there's like over 100, many won't really matter. It's going to ultimately come down to what China and Europe do. But I think even those are going to end up being, they're consequential, but I think they're going to end up being deals that are better than what we have right now, which is like the worst case scenario.
Hey, Tom, thanks for joining us, and just want to personally thank you for all the guidance you've given everyone over the past couple of years. I have a little bit of a two-part question here. The first part is, were you personally surprised by the tariff rates that the Trump administration came out with yesterday? This kind of reciprocal half rates. I think the market really didn't expect that we would go half of what the rates are that the other countries impose on us, and then sort of the numerical method to figure out those rates, I think, was really in question yesterday. And then B, piggybacking off of what you just said, do you think the Trump administration is imposing these kind of ridiculous, absurd tariff rates in order to cause so much pain in the stock market that people get scared, they buy bonds, and that gets bond yields to come down?
Okay. Well, yeah, I guess there's three parts to that. First, on the level of tariffs, yeah, I mean, that's negative shock. I mean, when you see when you see these rates, and I don't have it, I'm sorry, I'm just going to just pull up in front of me, but like the stated rates of like 46% for Vietnam, or 34% for China, on top of the 20% already, because of fentanyl. I mean, these are just eye-popping numbers. Like, you almost, if it's almost like, it's like a dark comedy, right? It's like it's what you'd expect in like a satire. They were so absurd, as like you said. I mean, these are absurd tariffs. And then what's adding to the absurdity, of course, is that they're not tariff rates, right? These are just calculations of the actual trade deficit as a percentage of basically what we're importing. So it is a really blunt way to try to calculate a tariff, but it's basically saying, we have a trade deficit, so in order to neutralize it, we have to raise prices by this, which is not really a tariff rate, and it's not even really, I think, even a cogent calculation of the nature of a trade deficit. So yeah, so they're so out of whack that, look, if this was based on, I'd actually probably be, I think the markets would have a different take if this was based on calculated tariffs and calculations of currency manipulation and government subsidies, and someone can try to attempt to tabulate these things. And I think if that was the case, or if they had like a scoring system of abuse, then I think it would feel like there would be a lot more certainty to these. But because I think these numbers just are arbitrary, and it's even created an impossibility for how like businesses can respond to this, right? Like, how does a business respond? Because is this so huge that I'm out of business, or do I have to onshore, or do I have to raise prices? I mean, they're obviously shocking. And again, that's why I get back to, like, I think April 9th is really going to be the more important date, and that's when we start to see breakthroughs, and we'll see how markets react. But I would expect people would be positively reacting to that. And then in terms of like causing stocks to fall, and pushing into bonds. I mean, I think a lot of people definitely can question what is the methodology to what this administration's doing. Like, because I think fairly someone might even say like, well, um, this seems even harder for us to track, and how are we supposed to be managing money? But I don't know if you caught Trump's remarks before he got on the helicopter today, but he was saying, he wants the stock market to roar again. I don't think he actually wants there to be a stock market crash, especially in response to this. I mean, maybe until April 9th, he doesn't care if markets are anxious, but the reason, he doesn't want that to happen is if we have a recession, the average fiscal stimulus to get us out of a recession historically is 2% of GDP. So, the White House would have to essentially authorize $600 or $700 billion of spending to reverse a recession, which would kind of negate the whole idea of like Doge and fiscal austerity. So I don't think they want. I think they actually want maybe the shock to wear off, and they want maximum negotiating leverage until April 9th. And so maybe they don't care if the stock market is stuck for a couple more days, but I don't think they want the stock market to go down.
On that, it's interesting the April 9th date, because April 11th we have earnings season really starting up with JP Morgan earnings, Jamie Dimon speaking then, and then Netflix the week after, and then mega cap tech coming after that. I'm curious, you were talking there like the uncertainty for us, just market participants, but for these companies must be crazy. So I'm just curious on what you're thinking for this earnings season coming up, whether it's around forward guidance and if companies will be giving them, or if their timing of April 9th is even important, relevant to earnings season coming up.
Yeah. Well, here, we put together like a table of like the worst hit groups today, and then the stocks. Believe it or not, there's actually like 20 industries that are actually positive today on the day. Okay, but the worst hit are home furnishing retail today, down basically 20%. Consumer electronics down 15, like Best Buys. Oil, gas, and drilling down 15. Footwear down like 14. Apparel down 13. So not surprisingly, companies that rely on either manufacturing overseas or even in Vietnam or wherever, other places that got randomly named like Malaysia. And of course some tech, but tech, of course, as you know, besides Apple, kind of are faring actually somewhat better. And even if a stock like Tesla is, I think, doing pretty well today, all things considered. But the stocks that are actually positive on the day, like tire and rubber, managed healthcare stocks are up like 3 or 4%. Water utilities, tobacco stocks are up. Household products, soft drinks, healthcare distributors, some food retailers, telecom services, packaged foods, some of the towers, brewers. Um, you know, I think that, like if you look at the stock market reaction today, you'd think that the whole world just got upended, and like we're spiraling into depression. And actually, I'm sure a lot of economists are maybe even saying that that's going to be the case. But uh, these are not. I don't. I think the economies can be fine, and I think that's going to be the message from earnings season. Is that companies that have good businesses and like moats and visibility, they're on the margin, probably pulling ahead. I mean, I think there's going to be some companies that look like, really superpower companies because they're less affected by this. And then, of course, the ones that are down today, they're the ones that have to rethink their strategy because, they do have supply chains that are stranded. I mean, I guess at the end of the day, it is, a fact that, in the next 3.5 years, it's going to be hard to make, shoes in Vietnam cheaply if there's a huge tariff on that.
Tom, following up on Tesla, I 1000% agree with you, and I think a lot of people would as well, which is that given the delivery numbers and given the volatility from tariffs today, you would imagine Tesla would be down like 15-20%. But it's kind of holding on. So do you think that is emblematic of the fact that the worst has been kind of priced in on Tesla and on earnings? Yeah, it might go down even more, but maybe we don't revisit those March 13th lows. And do you think it still could lead a potential V-shaped recovery?
Yeah, I mean, I think, I have to see how the closes today. I think it would have been better to see like, you know, the arms index hit 2, like the trend. But the put call, is elevated. So, some of the right things are happening. And today will be there'll be some positive divergences. So I actually think the technical picture is getting a little better. But one thing to keep in mind is that, since all this turbulence started, Tesla's outperforming by like 15 percentage points, right? So like let's say you took the March 13th lows and compare it to now, right? So we've like S&P's retested or whatever. Tesla's up like 15%. And Bitcoin's up modestly and MicroStrategy's up like 16%. So the things that were like leading us down at the start of this year aren't actually taking another leg lower, right? They're actually stabilizing here. So I'd probably say that's to me that's kind of a good sign, right? I mean, even like Palantir is actually outperforming the market today. So it's not, it's yeah. I mean that I'm hopeful it's soon. Like today is definitely a disappointing day. But like I said, the market's kind of just did most of the selling in the morning, and it's been holding this level. I mean, that's not such a bad thing. But I'd say the next point of visibility between now and April 9th is really when the next country makes a deal, right? And maybe it's not until April 9th, but from that point on, I think the investors are going to realize that today was the maximum point of negativity. So yes, I expect some V-shaped recovery, but now the timing is a little bit harder to judge just because we really don't have the Band-Aid completely ripped off until April 9th.
Wanted to jump in real quick. And first off, this was very cool, something that your team shared with us in advance of this for our listeners today, there's actually a 30-day free trial to check out your research on Fundstrat Research, and that's just fundstrat.com/Tom, TOM, for those that want to check that out. 30-day free trial, which is pretty cool. And obviously, within your research, one of the big things that's a focus for you right now is your ETF, which launched back in November. This is the Fundstrat Granny Shots US Large Cap ETF, GRNY is the ticker. I just wanted to get your thoughts on, that ETF in this current, market landscape and how you're approaching it.
Yeah, so I mean, Granny Shots, let me give a little background, is based on based on our research model that we've had in place since 2019. So for people who have been subscribers, we have a core portfolio called Granny Shots. And the way it's constructed is we look at the most important themes, multi-decade themes that exist out there. And today it's things like AI and cybersecurity, the global labor shortage, the millennial demographic, and the fact that the Fed is easing financial conditions. And we identify stocks that are most positively correlated to the theme. So in other words, we find the strongest stocks within each of those themes. But then you just end up with a huge portfolio. Really, to make it a granny shot, a stock has to appear in more than one theme. And that way you have a stock that has basically several levers of growth. And so that ends up with a concentrated stock list of around 30 names. And Granny Shots since 2019 has outperformed the S&P, that research list, every year for 6 consecutive years. And it's now an ETF. Now, of course, the ETF is having a tough year this year because the S&P is in a drawdown. But I actually think that that's not surprising to me because it's not designed to be a defensive portfolio. It's really designed to give you exposure to the most important ideas. And so, like names that are in it are things like Palantir and GE Vernova and Costco. But it does have financials like Goldman Sachs and JP Morgan. I mean, these are basically the most important companies that are tied to the most important theme. So, I would think of it as once we're through the tariff turmoil, which is what we're experiencing now, these are all the names that investors are going to want to own, but they also have the best earnings growth. And our process does make sure we're not buying, insanely expensive stocks. So that's really the approach to Granny Shots. And by the way, it's named after Rick Barry, named after a way of shooting free throws, which is underhanded, but it was popularized by NBA Hall of Famer Rick Barry.
Yeah, I saw the graphic on your website talking about like the 93% shot, doing it underhanded. So, Tom, we're coming up on the 30 minutes we have here. We really appreciate you joining in. People should go in, like Gav was saying, the research up in the nest above, given a 30-day free trial. Seems like now might be a great time to go in and check that out. Since we pinned up in the nest above, the link is up there. But Tom, I want to know if you have any final thoughts, anything you want to leave the people with. Seems like we're kind of in a little bit of uncertainty until April 9th. We'll see, but I want to get your thoughts. Appreciate you.
I mean, look, I know this is the day that you're going to feel maximum bearish, okay? And then you want to either get out of stocks completely, but just keep the following in mind. One, for this entire decline in the S&P that's been taking place, the bond market hasn't been as ruffled. We look at high yield spreads, and high yield spreads they've widened, but they have not even made 1-year wides, meaning they're barely reacting to all of these tariff headlines. And when stocks and bonds diverge, I would just say this: the bond market's the better economist. The second is, it's pretty rare to have an opening gap down of 3.5% decline. In fact, we've just put this together, and this is the 7th largest negative opening gap in 40 years. And just to give you some stats, because there's always different context, But if you look at the 6 that preceded it, the 6th worst, okay, and you said, what did stocks do 1 month later? 6 out of 7 times the market was higher. So I think we're flushing out a lot of panic here. Obviously it's orderly, but we're still flushing out a lot of panic. And the VIX is elevated. It's strange. This sounds strange, but you're better. You make more money when you put money to work at a high VIX, because the VIX is measure fear, and so the VIX can't stay at 30 for a month. So as the VIX starts to calm down is when investors come back into the water. So it's painful today, but I wouldn't give up hope at all, even for a pretty sharp bounce again. But I'd say it's going to probably happen more around April 9th, if I had to guess.
Appreciate you, Tom. April 9th. It was great having you on the spaces, and look forward to maybe having you on again.
Great. Thank you.
Appreciate you, Tom. Awesome. That was a fantastic chat. Also, shout out to Amit for being up here. We had like 4,000 or 5,000 people also listening on his YouTube live stream. Now he's going to continue doing his thing. But appreciate everyone for listening in. Stock Talk. We got.
All right, cool. There we go. We are heading into the market close now, and that was Tom Lee on the state of the market. So I just want to quickly recap what he said. We got to ask him 2 questions here from my side. First of all, thank everybody for being here. Really appreciate it. Appreciate all the love and support in the chat. I didn't realize that I have jazz hands when I ask questions. I don't know. I didn't realize I like talk with my hands when I talk, but I guess that's just the way it is. I asked you guys in the chat, why am I so good with my hands? Don't answer that question. I already know what you guys are going to say, so I don't want to see the answers. But okay, so we asked 2 questions. Number 1 was, it was actually 3 questions, because the first question was a 2-part question. The first question was, hey, what did you think about the rates that we got from the Trump administration yesterday? These like ridiculous 35%, 45% rates on all these different countries. And then 2, what do you think that means in the context of bond yields? In regards to the fact that maybe Trump is being the Joker and he's causing all this chaos with these like insane rates to be able to get people to be afraid of stocks, sell them, buy bonds, and get yields to come down, which has kind of been that theory that has been floating around for a couple months now. Tom Lee's answer was basically the following. Number 1, he unequivocally agrees that, now I'm using my hands like crazy. What's going on? He basically agrees that it is ridiculous for the rates that we got yesterday. He and a lot of other people, including Dan Ives and a bunch of other economists this morning that I've been reading from, basically have no understanding of how the hell he got these rates or how these numbers make any sense in the context of the reciprocal quote unquote tariffs that the administration has calculated. So if you're curious about Tom Lee's perspective on the actual rates we're imposing on other countries, he's not a fan of it. And he thinks that these rates don't make any sense and that there will have to be some level of negotiations to deal with those rates not being as aggressive as they are. Number 2, in the context of the bond yields, he kind of agreed and disagreed. He said, yeah, I do think the Trump administration is trying to cause some problems in order to get yields to come down. However, and it's a hell of a however here, the more bond yields come down, the more we have a chance to price it. I mean, that's essentially what the bond market is doing, right? They're buying bonds because they're thinking that there's a shot we're going to get a recession. So they want to lock in their 4% yield, 4.2% yield, because the equity risk premium is going to become very large if the stock market continues to fall. Bonds would be cheaper. His argument here is that it's pretty scary, because if you have a recession, the United States federal government would have to spend lots and lots of money to stimulate the economy. Tariffs at that point would be a death blow to the economy if we end up truly in a recession. 538 right here on the S&P 500, 4.65%, 25 minutes until the market closes, and we are hitting a new low for the day. I can't remember a time other than 2022 where we actually had 4.5% down on the S&P, and in 25 minutes, if we close 4.5% down, then it'll be the first time we've seen that in the past couple of years. So basically, Lee has been Tom's argument here was, hey, if we do get bond yields to come down, which they are coming down today, they're down from 4.8 for the year at 4.01% right now. Hopefully they come down below 4%. But the sort of a fine line that you have to navigate is a recession. And obviously, if we have a recession, that's going to be good for nobody. It definitely won't be good for the stock market, and it obviously won't be good for the fiscal debt that we're dealing with as well. Yes, we will be able to refinance our rates at a lower level, but it's kind of a game that Trump's playing, right? Can we refinance our rates at such a low level based on the bond yields collapse, based on the 10-year collapsing, which will cause the stock market to essentially collapse as well, while at the same time not cause a recession, so that after we refinance our debt, there is a massive bounce in the economy, which means we bounce from wherever lows that we end at in the stock market. And that leads the bond yields to then start going up, but it doesn't dramatically shoot them back up to the point where we are stuck with these 4.5% rates. I mean, it's a very, very complicated move that the Trump administration is trying to engage in. And based on the stuff we watched this morning, it's unclear if Besant, the Treasury Secretary, agrees with all these moves. I mean, quite frankly, when he was asked, hey, does China have a 54% tariff because we already had 20% and now we're imposing 34%? He said, I think. You think? One of our biggest trade partners, and you think that it's a 54% tariff? You don't know the exact percent. That's something I would imagine you know. And then another question he was asked about, what about Mexico and Canada? Why were they excluded from the list? His answer, I don't know. I mean, come on, bro. It's just like the level of that's not giving the stock market confidence in regards to what the plan is when the Treasury Secretary doesn't have answers to two of the most basic questions about three of our biggest trading partners, Mexico, Canada, and China. So I think from that perspective, and that's basically what Tom Lee underscored in the spaces, which is that level of uncertainty is going to be pretty rough for the broader market. Now, one thing he did say as well is that the real partners that this affects are China and the EU. A lot of the other countries like Thailand and Venezuela and Madagascar, like those matter, but in the grand scheme of things, it's China and the EU. So Tom is expecting us to get a deal with China and the EU. And he says April 9th is when a lot of the tariffs actually go into place. So he's kind of giving this grace period of the next 6 days to see what happens until we get there. But his core argument is, hey, the EU and China are going to have to strike a deal with the United States, because if we actually impose these reciprocal tariffs and then enter into a legit trade war, it's going to get ugly. It's going to get very ugly. And yeah, Tom Lee tends to be bullish, and I think he was bullish here because he's not calling for a sell your stocks or there's this massive recession that's going to be happening, but he is calling for some caution around what the administration is doing with tariffs right now. Final question we got to ask him about is Tesla. His argument was pretty much what a lot of people have been saying, which is that, yeah, a lot of the worst news might be priced in. I mean, quite frankly, on a day like this, I cannot believe that Tesla is only down 6%. I know 6% is a lot, but given the forward earnings multiple and given the horrible delivery numbers, which might not change in Q2, yeah, it's holding 260. It's holding an $854 billion market cap. And so Tom's perspective there was that if we do have a V shape, which he's not as confident we're going to get a V shape anymore, it might be led by Tesla. But after April 9th, we'll have a lot more data on if that V shape ends up happening in the first place. So that's what we got from Mr. Tom Lee. Thank you, everybody, for being here. We'll get into the official market close now. We got a lot of other topics to discuss and keep going from there. I guess first question before we get started with everything else, how's everybody feeling? Did you buy? Did you sell? I bought a bit of the dip. I bought Grab, Robinhood, NVIDIA, and Google. Not a lot, but just a little bit of a nibble. Look, I'm still of the mindset, and I know it's going to be super cliche, and I know people are going to hate me saying this, but these are the days where people don't want to buy, but the whole point of DCAing is that you don't know when the bottom is, but you're willing to deploy some capital when you see steep discounts. Could all these stocks go lower? Of course. Could the market go lower? Of course. But if I was perfectly hedged and I knew how to time the top and the bottom, I'd probably run a hedge fund, right? So if you're, 99% of us are long-term investors. On a day like this, when a stock goes down 10%, one of your favorite stocks are down 8 to 15%, I mean, yeah, you take a little bit of a nibble. Also today, I went for a walk. I got on a swing set near my house. It was in this like local park. I got on the swings. Quite frankly, the physical swings were giving me less motions than the stock market swings. So I kind of put my phone away for a little bit, put on the headphones, listened to some music, and I swang on a swing set. I legit did this like an hour before the Tom Lee Spaces. Got my mind off some stuff, and the weather's great in New Jersey. It's beautiful. It's like 70 degrees today, so had to take advantage of the beautiful weather here. A lot of you guys are saying I bought some of the dip. I bought Meta, NVIDIA. And I want to buy Meta. I have not yet. I'm very excited to establish a Meta position. Have not yet, but hopefully eventually Meta becomes attractive enough. Tom's ETF that he talked about was GRNY, Granny Shots. So if you're interested in that ETF at all, he was talking about it at the end of the show. GRNY is his current ETF that he manages. Amit retreated to childhood. You know, I've always loved being on the swing sets. Like ever since I was a kid, and you know, if you go on the swing sets and when you swing and you get really high up and you close your eyes and then you fall back down, it's almost like your stomach drops. It's like just like a fun roller coaster experience. But that to me was less swingy than the stock market. So yeah, did some swings here today. Meta's at 530. Holy crap, dude. Last time I saw Meta was 550. Wow. Down $50 today, 8%, 533 on Meta. S&P 500 down 4.5%. Nvidia down 7%. We got Nvidia at 102.59. We did hit a low of 102.01, but we bounced really quick from there. But it looks like in the next 20 minutes, Nvidia is getting ready to close at that 102 level. Yeah, we got a bunch of you saying you bought some Nvidia here, bought some hood. I did buy some hood today as well. You're telling me Tom Lee just got interviewed by a grown man who spent his day swinging. Dude, you should try it. The swings are fun. I love going on swings. It's a good time. ELF is down 20%. Yeah, all the Chinese stocks are getting demolished. ELF down 20%. Shopify, which isn't even a China stock, but people sell a lot of stuff from China in their e-commerce stores on Shopify. That's getting hit. And then obviously Nike is getting hit as well, 13%. We just had Trump before he got on Force One give a little bit of a quote to some reporters. I haven't seen it yet, but I do have the video. So let's look at it right here. This is what Trump had to say before heading on Air Force One today.
I think it's going very well. It was an operation, like when a patient gets operated on, and it's a big thing. I said this would exactly be the way it is. We have $6 or $7 trillion coming into our country, and we've never seen anything like it. The markets are going to boom, the stock is going to boom, the country is going to boom, and the rest of the world wants to see, is there any way they can make a deal? They've taken advantage of us for many, many years. For many years, we've been at the wrong side of the ball, and I'll tell you what, I think it's going to be unbelievable. The thing that people have to talk about, we're up almost to $7 trillion of investment coming into our country. And you'll see how it's going to turn out. Our country's going to boom.
So Trump says the stock market is going to boom. Yes, we are bringing $6 to $7 trillion of foreign investments, which is what Trump has announced. It hasn't been official yet. But the stock market today lost $10 trillion. So, yeah, I mean, obviously, ugly day in the stock market, even if we're going to be bringing in some foreign investments. Again, dude, this is going to be the inevitable debate. And I don't think anyone really, I mean, even Tom Lee struggled to really give a definitive answer on this. Does this White House actually care about the stock market, or do they care about bond yields? And if they don't care about the stock market, which I think we have good reason to believe they don't, and they care more about bond yields, will they be able to manufacture the ability to get bond yields down, not crash the economy, get inflation to come down, and still allow the stock market to be elevated enough to the point where they don't, and then here's the political angle, lose the House and the Senate in the midterms? The first 100 days of this administration are coming up pretty soon. And I mean, that, like, I don't know if a stock market crash is enough to get the Republicans to lose the midterms, but a lot of Americans own stocks, even if they don't stare at every candlestick. They own 401ks, right? And so from that perspective, it's going to be one of those things where we're going to see how low is the administration willing to let the stock market go, and how much do they think their agenda around true free trade and fair and reciprocal negotiations with countries, how much does that outweigh equity prices and overall investment in the United States? I think over the coming weeks, we will have a better understanding of what's going on there. Cool. So that's what we got in the context of markets. We will get money market inflows data soon. Do we have it yet? Yeah, I got it. All right, put it in the chat. Do you think we increased or decreased today on money market funds? Increased or decreased? Last week, we increased by 11 billion. We have 7 trillion on the sidelines. I got the data right here. Let me know what you guys think if we increased or decreased. I think this one's obvious, right? This one's not that hard. This one's pretty obvious. Yeah. All of you guys got it. All of you guys got it. We have increased money market funds, not by crazy, but by a good chunk, 17 billion. So total money market fund assets increased by 17.6 billion to 7.03 trillion on the sidelines. Now, we talked about this in the morning. Look, and you know, Tom Lee and a lot of economists still reference this money market funds number because that's a lot of money that's still on the sidelines. And although $10 trillion left the stock market today, at what point do risk on assets become so incredibly I guess cheap is the right word, or just they become so incredibly priced that the average person realizes that 4% in a money market fund is just not enough for the risk that you could take on buying Google or Nvidia or whatever it may be. Addy says, when do you see the Fed lowering interest rates? Well, that segues into the next topic. The CME probabilities on the May rate cut is now 21%. This number was less than 12 on Monday. So we have seen a bit of an increase right here. This is another reason why some of that money in money market funds might start to get deployed before May 7th, the next FOMC meeting. Because if Jay Powell sees all this volatility and he ends up cutting rates, obviously stocks will get more attractive. Now, the problem here, and this is, I think, one of the biggest things everyone needs to pay attention to. If Jay Powell, who's going to be talking tomorrow at 11:25 a.m. Eastern, I'll be streaming it. He's at some economic club. We'll get his reaction to what's going on with tariffs. If it is very obvious that Jerome Powell believes that rates are elevated to the current levels that they need to be at, given the labor market is strong, right? We got that initial jobs claims data today, private payroll data yesterday. Job market so far is healthy, not recessionary. And he believes that tariffs will be inflationary. He's not cutting because, and we're going to kind of read between the lines based on what he says yesterday, because if he cuts, we might legitimately enter stagflation. What is stagflation? Growth slowing down, aka tariffs, and inflation going up, aka tariffs. You have inflation up, you have growth down. That's just the worst stock market environment you could ask for. It's the worst economic environment you could ask for. And Jay Powell has avoided stagflation for a while. So I think based on the extent of how inflationary Jay Powell believes the tariffs will be, if he thinks it's going to be transitory or if he thinks it's going to be not as transitory as he said in his last FOMC meeting, then I don't think we're cutting rates. Because to cut rates, you would have to believe that inflation is going to naturally come down. But if the tariffs create more inflation, inflation's not coming down. Unless tariffs create a recession and the recession causes inflation to come down. But if that's the case, then the stock market's down anyway. And it doesn't really matter if he cuts rates because everything's going to get hit. In the face of all of this, the number one thing that actually matters, in my opinion, is Q1 earnings. And once we start to really see what Google says, what Nvidia says, what Amazon says, what TSM says, what Shopify says, what Delta says, American Airlines, all these companies, Pepsi, Coca-Cola, what are they actually saying about the state of the economy? Then I think we'll have a better understanding of what to expect. But I'm not so confident Jay Powell's going to cut rates if he thinks that tariffs are going to be inflationary. S&P 500 right here, 538.22. We have 12 minutes left until the market closes. It does look like we are seeing a 4% decline as we end out the year, or not the year. We got a lot of time to end out the year. We got a lot of time in 2025 as we end out the day. Adam says Jay Powell messed up when he cut rates last year. If he had held rates for 2 more months, inflation and rates would have been behind us. So I don't necessarily agree with that. And the reason I don't agree with that is because I think cutting rates was the right decision. The problem was Trump threatened tariffs. And in hindsight, now it makes sense kind of how the market's reacting to it. But remember, one of the reasons that the Atlanta Fed is projecting negative 3% GDP growth is because we imported so many goods in Q4, or when I mean American companies, to avoid the tariffs that they were expecting to happen in Q1. We got those tariffs a couple days after Q1. So those companies were absolutely correct in trying to import early. And as a result, that created a lack of imports in Q1, which is affecting GDP growth, but B, it created more inflation because now companies are trying to order a lot of excess inventory. It created a lot of supply chain bottlenecks as well. And so I think cutting rates towards the end of the year was not the worst decision. I know there's a lot of academic debate here, and yeah, you can make an argument for why we shouldn't have cut rates, but it was the fear of tariffs that created so much import demand that led theoretically, at least from one angle, to some of the inflation that we're experiencing right now. Even though inflation is not exploding, CPI and PPI came in well below than expected 2 weeks ago. And next week, we're going to get the March CPI data. So having said that, yes, is inflation elevated? Yes, but is it going crazy? No. And the question is going to be, can we keep it under control over the over the coming weeks. Let's get an update from Brad Gerstner. This is the chairman of the Altimeter Fund, someone I respect in terms of his investing analysis, and let's get his thoughts on what he thinks about tariffs.
Some really ugly market times, and you always were there for our viewers, and I appreciate you being here today.
It's good to be here, Scott. You know, I'll never forget, I think it was March 26, 2020, when we troughed after the start of COVID. And ironically, the last 35 days, the NASDAQ is down over 10%, which is the same as it was down in that period of time. We haven't seen this bad of market reaction out of the NASDAQ since the start of COVID. So this is a consequential time. And, you know, I always say to you, you know, you show up in the good times, you got to show up when it's tough. And today's a tough day. So happy to jump into it.
What is your reaction to what was obviously much worse than expected?
Well, as you know, I've been saying to you since January, I've said on our podcast, the BG2 pod, we've been very negatively positioned. In fact, the most negatively positioned altimeter's ever been positioned over the course of the last 30 days. We started today at 5% net exposure to the market because we were worried that this was going to be a lot bigger than people thought. And we thought the White House was telegraphing that over the course of the last 6 to 8 weeks. I said on Squawk Box a few weeks ago, you know, in 2024, the total amount of tariff revenue to the United States was $77 billion. And I said on Squawk, if you think that's going to $700 billion, you know, which is McKinley style, protectionist style tariffs, you got to get out of the market, right? The market is not pricing that in. If you think, on the other hand, that Trump is more for fair trade, going to make adjustments to trade that's going to generate 200 to 300 billion in tariff revenue, which would be on the smaller side, then I think the market's pricing that in. And what we
Okay, so I'm just seeing Newsmax, that IPO is up 18%. This is what I mean. Like, this is a wonky market, dude. The Nasdaq's down 5%, Apple's down 10%, Newsmax is up 20% right now. I mean, it's a really weird market, and you've got a lot of weird things happening right now, but it kind of doesn't make sense that Apple's down 10, but Newsmax is up 20.
Got yesterday was even bigger than the high end that Peter Navarro and Howard Lutnick had been, conditioning the market to expect. And so I think it was very surprising to market participants, as evidenced by the fact that we have massive gap downs in the market today. You see stocks down 20, 30, 40% today. The NASDAQ's down 5%. And I talked to probably 10 CEOs who are all in the business roundtable. These are CEOs of the largest companies in America overnight. And 201, they think this is a huge mistake. They think this is too much, that it will have lasting and cascading negative repercussions for the United States and the global economy. And so we're on the verge of hearing earnings calls out of the Fortune 100, out of the S&P 500. And it's very hard for me to think that any of these calls will have an air of optimism about them, because whatever you think happened over the course of Q1, and I'm pretty certain that there was slowing in the economy in February and March, and that will continue into April with these announcements. But whatever you think has happened in the past, it's very hard for these CEOs to be optimistic or to plan for the future when we're in this fog of war about tariffs. They don't know what to do today. And I think that's a very dangerous place for the economy that was already slowing.
Now, in the midst of that, Brad Gerstner is still buying NVIDIA.
And you're very plain in the criticism that you have about how this all came out, the severity of it, and what the ramifications might be. You're more net long now than you were prior, and you've added to some long positions, including, I'm told, NVIDIA, which is ugly today and has not traded well at all lately. Why was this the moment to add to that stock?
True. The semiconductor index is down 20%. NVIDIA, as you know, is down from, I think, a peak this year at 150. So this stock's down by a third. Remember, we entered today in kind of bomb shelter positioning. We had puts on the NASDAQ. We had tremendous number of shorts. We're sitting in a lot of cash. We only had 50% of our long book even positioned in the market. So we're dramatically outperforming on a day like today. So we're going from the bomb shelter to simply, our safety positioning. And that means adding about 15% of net exposure. And we're adding it in the areas that we believe we're continuing to see secular growth. And as you know, the growth and the demand for GPUs is off the charts. You hear it from OpenAI, you hear it from Google, you hear it from Elon, you hear it from others. I know there's a debate about that, but that's the side of the debate that we're on. And then although we saw these tariffs announced yesterday, we also saw a list of exceptions. And one of the list of exceptions, wise exception, is semiconductors. And I think the reason that semiconductors are being accepted is because for us to charge a tariff on our own chips, right, which are fabricated in Taiwan because they can't be fabricated in the United States, we don't have the fabs yet. TSMC, who he mentioned in his speech yesterday, has committed to massive investments as a result of the president's policy in Arizona to build cutting-edge fabs. But right now, he gave them an exception because we know if we increase the cost of these chips that we design to our own companies like Meta, like Google, like Microsoft, like OpenAI, we're only shooting ourselves, right? Because we're in a global race in AI. We can't hamper our ability to win that race. And so I think that was a wise decision to put them on the exception list. I'm sure he's going to keep an eye on whether or not the fabs are being built in Arizona. But I think we're going to net end up in a much better place in terms of our global supply chain as a result of these decisions. But that's the reason we're buying NVIDIA today. We think the demand is off the charts. We think the negative impact from tariffs is going to be much less than in other areas. But listen, if we end up in the teeth of a recession, then even NVIDIA at 18 or 19 times earnings might not perform that well. Like, we need to avoid a recession in this country. I think it's very bad if we find ourselves in the fall in a recession, and we're heading into the midterm elections in 2026. I don't think the president, the administration, or Congress want to risk a recession, toward the end of this year.
We'll take a quick break.
It's a fair point, right? I mean, Brad's argument right there is that, hey, he's buying NVIDIA because he thinks it's cheap based on this multiple compression. If you believe in the forward growth, Newsmax right there up 16%. But the caveat, which is almost exactly what Tom Lee said, if we get a recession, all bets are off the table. And the one thing I've been hearing by a lot of the kind of mainstream Wall Street guys, Brad Gerstner, Dan Ives, Tom Lee today, is that they aren't fully sure if the tariffs that Trump imposed yesterday, if they go into effect, if they aren't recessionary. I mean, quite frankly, their opinion is of the opposite, which is that Dan Ives kind of made it definitive today, which is that if these are the tariffs that will be imposed for the coming years, we will head into a recession. So I think they're saying to cautiously buy the dip is the takeaway from them. One, because, I mean, if you were going to sell, the time to sell was probably a month ago, not exactly right now, because it's a little bit too late now. Granted, we could go down another 20%, but the odds of playing that are just not necessarily on your side. And then B, if we do get a recession, buying this dip, obviously the dip can keep dipping, and that's why it might not be the most attractive opportunity here, even though these stocks are beat up so much already. I mean, I don't know when's the last time we've seen Apple down 9.3% in a day, but that's what we're seeing right now. So their default argument from everything I've read today is that they don't think these tariff rates are going to last. They think it's just so absurd that we are going to have some level of a bottoming event happen when we engage in negotiations and when we kind of clear up these types of trade deals. And that's why you buy the dip. But if you do believe for the next 4 years, we're going to be charging 40% tariffs against the EU, or 20% tariffs and 34% against China, or 54%, then yeah, obviously you would be scared, and it would be hard to buy the dip right here. All right, here we go. 9 seconds left until we close. S&P 500 looks like it's going to go down about 4.8% on the day. Thank you, everybody, for being here. 4 p.m. Thursday, April 3rd. The day after Liberation Day has turned into Liquidation Day. The stock market is now closed. All right, we're done. We got through the day. The one thing that to remember for everybody here is that the reason you guys can have astronomical gains in the future is because you're willing to go through some really tough days like today. But nonetheless, we got through the day. S&P 500 ends out the day down 4.75%, 537.72 on the S&P 500. NVIDIA closes down 7.8%, 101.8. Apple closes 9.25% down, 203.19 on the day. Carnival Cruise down 13.7%. Royal Caribbean down 11%. Grab down 7.59%. Hims down 10.4%. Amazon, did not expect this one to get hit this bad, but obviously with the tariffs, it makes sense. A lot of stuff is sold on Amazon, and it's from places like China, down about 8.9%. Palantir, I mean, Tom Lee did mention Palantir, down 4.5%. Palantir and Tesla both. You would think these stocks with such high beta and with such aggressive multiples from a price to earnings, price to sales, however you want to measure it, you would think they would get clapped in this sell-off. And down 4% on Palantir just isn't that. Same thing with Tesla, down about 5.7% of the day, holding 260. Palantir holding 83. So those two obviously still red on the day, but just not as red as some of these other stocks in the market. You got PayPal, that was down 8% on the day. Arc Innovation down 8.2%. Verizon and Crown Castle were green. Verizon and Crown Castle were indeed green, so those were a little bit of safety for today. Bitcoin was down about 2%, 81,000.8. Lululemon, a lot of China exposure there, down 9.58%. I'm going to see if I can go return that $150 Lululemon hoodie that I bought 2 weeks ago. I don't even know if I have the receipt, but I would like those $150 back right now. SoFi down 13.5%. Robinhood down 10.3%. Red Cat down 8% of the day. Costco was green. Google was down 4%. Uber was down 7%. Alibaba was basically flat, down about 0.3%. Reddit down 11.5%. Rocket Lab down 7.5%. BlackBerry down another 7.5%. Walmart kind of held up, only down about 3%. And then you had Microsoft right here, down 2.36%. If we look at the semiconductor names, we'll talk about Intel in a second. The reason Intel still ended the day down 1.2%, but it was up 7% is because they announced a new partnership with TSM. And that partnership seems to be good for them. I haven't read too much into it, but we'll look at it in a second. These guys still down 2% of the day. SMCI down 8%. AMD, wow, 93. That's new lows for the year. Yeah, 93, down 9% on AMD. And then NVIDIA down 7%. ARM was down 9%. Dell was down 19%. That was ugly. I didn't look at Dell all day. Qualcomm was down 10%. Broadcom was down 11%. ASML down 7%. In the context of the Mag 7, Meta down 9%. Zuckerberg was at the White House yesterday trying to lobby Trump to not get the FTC to investigate them. That one getting hit 9%. Google down 4%. Amazon down 9%. NVIDIA down 8%. Tesla down 5%. I mean, Tesla kind of was the best out of the Max 7. Microsoft down 3%. And then Apple right here down 9.25% on the day. Micron as well, along with Dell. Both of those getting hit. Wow, Micron 16%. You know, a lot of these, I mean, if NVIDIA is going to fall 30% for the year, it's hard to see the other supply chain companies or the other semiconductor companies that are part of the broader supply chain for a lot of these GPUs. They're going to get hit as well, even though NVIDIA's earnings have not got hit yet. So technically Micron or Dell's or SMCI's earnings shouldn't be hit either. But their stock prices obviously are getting hit given what's happening to NVIDIA. Make it stop them. I cannot make it stop. All we can do is kind of get through and deal with the pain that we're going through right now and try to make sense of it, right? Like, I think one thing to be a bit more emotionally mature about this, like, I hope no one's crying today, right? I think like, I just like, if you've been in the market for even a couple years, especially if you've been in since 2022, and, you know, a lot of you guys have been in here since 2008. I mean, dude, everyone thought the world was falling apart during COVID, and it did for a second, and then things recovered. You know, yes, did we print a lot of money? Yes. And I'm not even talking about the stock market. I'm just talking about the general state of the world. We got through it. I don't think what Trump announced yesterday with tariffs is even 1/100th of what the global panic was during COVID. Definitely nothing like it during the 2008 financial crisis. And so does it have a chance to become that bad? Sure. Anything could get that bad. But I don't think this is the day to panic and cry and be afraid that you bought NVIDIA at 120 or that you bought, I don't know, Shopify at 95 and it's at 82. I mean, these are the days where, look, if you bought in March of 2020, you did very well 5 years later. Very well. I mean, Shopify was trading at like $20 at the time. Now it's at 82. So I just think it's one of the days where you don't freak out. You try to reduce a lot of the leverage that you have. If you're leveraged, if you're on margin, yeah, it's definitely going to be hard to sleep at night. You might have to take some L's and get off that margin to have more peace of mind. But I also don't think this is the time to panic. I think this is the time to take a little bit of a nibble and and DCA. Because again, you know, and I know it's so cliche, but everyone wants a 10, 20% discount, but then no one wants to buy when there's a 10, 20% discount. That's the problem. And it's like, it's so easy to chase it when it goes up. It's so easy when Robinhood's at, when Robinhood goes from 43 to 49 for you to say, all right, I'm getting in at 49. And it's hard to get in at 38 when in reality, when you're buying at 49, you would have loved to buy it at 38. And if nothing fundamental has changed around the macro or the company that you're buying, then DCAing ultimately is the best way to play it out. Amit, are you a buyer right now? Yes, I bought NVIDIA, Google, Robinhood, and Grab today. Not a lot, but kind of practicing what I'm preaching right here, which is that sometimes you have to take a little bit of a nibble if it's that bad. Because what if this is the bottom? You know, and I know some of you guys might be hearing this and thinking we're going to get into a recession. We're going down another 50%. You would hate me saying that, but what if you're wrong, right? And you could not be wrong and just be like, Amit, stupid. We're about to go down. You know, Nvidia's going to 70, and then you don't have to buy, right? That's what makes a market. Someone buys, someone sells. But the point is, you could be wrong, or you could be right. And then the DCA to me is just an acknowledgement of I don't know, and I'm going to take my best educated guess that a stock down 30% year to date, trading at 22 times earnings, down 8% on the day, off of something that probably is going to go away in the context of these ridiculous tariff rates that have been imposed on other countries, because we're not going to tariff the entire EU at 25%. Maybe that ends up leading to a bounce eventually. But obviously, everyone has to make their own decisions here. Amazon up a little bit after hours. The entire market getting a little bit of a boost after hours, up about 0.2, 0.3%, but everything else still relatively red from what we had today. Yeah, fear and greed is at freaking 9, bro. I think during COVID, we got to 6 on fear and greed. So this is the lowest we have seen fear and greed. The 10-year is at 4.004 right now. We have not seen fear and greed at these levels in since 2022, and then in COVID it was at 6. And that's what I'm saying. Is the world shutting down like that we did during COVID? No. But are we trading on a fear and greed perspective like it is COVID? Yeah. And to me, there's a little bit of a misbalance there. Yeah, like it feels like it's World War III, right? And it's like I hope it's not World War III, but it doesn't feel necessarily like it's World War III. It feels like Trump said some crazy shit yesterday to create negotiations. I'm not justifying it. I'm just saying that's what it feels like. And hopefully those negotiations could end up playing out. But that's what we are seeing right now. I have 905 shares of NVIDIA. 900, so we're officially up to 905 shares. Last time I had like 850, like a week and a half ago. So over the past week, added about 65 shares. I also did, you know, in the face of all these tariffs, I collected my damn dividends. I am a dividend investor. I believe in the ability to compound dividends over time. And so, you know, as you guys can see right here on the screen, collected my $8. And it is what it is. It is what it is. 0.001 cent per share. So, yeah, in days like this, you got to remember that when you get dividends, especially when you have to when you have to pay short-term capital gains tax on them. It's just the nature of being an investor. My NVIDIA average, what is my NVIDIA average? My NVIDIA average is 120.68. 120.68. Bro is ready to fight the whole world with that $8. Yes. We got I can buy 2 more Saratoga bottles with it. Exactly. What do you think of the HSBC downgrade? I thought it was BS. I mean, like I was talking with Steve about this. I was like they downgraded NVIDIA from 175 to 120 on one of the worst days of 2025, ironically, or just coincidentally on the worst day of 2025, they put out a target that is significantly down from what they've had for the past couple months now, based on the fact that they think the architecture for further chips is not going to be as strong as Blackwell in terms of demand. Maybe that's the case. But even if that is the case, which there's a lot of disputing, I mean, you got a lot of other NVIDIA analysts that would just unequivocally be like, this makes no sense. I still think you are pricing in a incredibly cheap multiple in the context of where NVIDIA's growth will come from, even if you take off some points from gross margin and you take off some points from their net profit margins. So this is where you got to put, this is a fork in the road, right? You either believe in NVIDIA or you don't. I mean, this is for a lot of these stocks, right? The S&P, you either believe in these current forward valuations or not. You either believe that Amazon's not going to be that affected by tariffs or not. Whatever stock you're buying, like Robinhood, quite frankly, if you're buying Robinhood right now, you are believing that that we are in a bull market, because Robinhood is a proxy in a bull market. So if we're in a bear market, you don't buy Robinhood. because Robinhood's going to have horrible trading volumes, horrible net deposits. Like every metric that I track as a Robinhood investor goes down. As a long-term play, I would be very excited if Robinhood got like below 20 or something like that, like, you know, some ridiculous number. But in the short term, could I see it getting there? Of course, if we're in a bear market. Me buying Robinhood today means that I don't believe we're in a bear market. And so that's my clarity of thought on this. Could that opinion change? Of course. But I think whatever stock you're buying right here, you've got to have a definitive opinion on why exactly you're buying it as well. Shopify down 18%. Correct. Shopify down 18% on the day as well. Retail investors get too emotional to be good investors. Yeah, I agree. And look, I still get emotional to this day. I've definitely been emotional in the past, but I know people hate to say it, but like on these types of days, you take away the emotions and you compound your capital into assets that you believe will be worth more than they are today, even in the midst of whatever happens over the next 1 or 2 years. I mean, really with a 5 to 10 year trajectory. And I know people hate hearing that, but that is on days like this, all you can think about. I think the time to sell was not now. Like, let's say Nvidia does go to 90. Oh, and you sold at 102 and you bought at 120. Like that would be my scenario. I don't think that makes a lot of sense because you got to bet that you would be able to catch a new bottom, or B, you have to bet that this is not the bottom. And that's just really hard. And unless you fundamentally understand the stock so well, and like, you know, something the rest of the market doesn't understand, and you understand the nitty gritty details, which maybe that's the case. But if not, it's just hard to be that smart in the context of all these stocks. And again, going back to Palantir and Tesla, dude, I mean, if anyone has a theory on why these two stocks are holding up, let me know, because this to me is a classic kind of textbook argument around how these two companies have something very special. Palantir with their ontology and them being a true AI software enterprise play, Tesla obviously with robotics, FSD, etc. And the market is ignoring the very expensive multiples that these two companies are trading at in the midst of a stock market decline where those multiples should be getting destroyed. That's not happening. Maybe it happens tomorrow. Maybe it happens next week. But at least so far, on one of the worst days of 2025, one of the worst days of the past 2.5 years, you're telling me Palantir and Tesla are down 5%, and they're still elevated at levels that are far more expensive than an Apple and an Nvidia when they're not growing as much as like an Nvidia. You know, it's pretty incredible. So I think that's also the market potentially saying we kind of are calling BS on these tariffs, because I just think the most high beta stocks would get hit even further. But that's not exactly what we saw today. Let's get a little bit from Josh Brown and his thoughts on what's going on with tariffs, and then we'll keep going from there.
2 weeks ago on a Thursday, and I said we're basically in a bear market. Statistically, the median stock was there. The index hadn't quite gotten there, but it felt like a bear market. And one of the things I've said maybe a million times since I've been on the show is nothing good ever happens below the 200-day moving average for the S&P. Where we stand right now, we had this conversation last week. Or Tuesday, we have a clearing event when this big bad announcement finally comes out. And it's true, Scott, a lot of these big bad announcements have served as capitulatory buying opportunities, clearing events, whatever you want to call it. What makes this one different is that it's not a market event. Secondarily, it is. It's really an event that impacts the real economy, Main Street. And one of the things I've been focusing on is the consumer. The consumer is what kept us from having a recession in 2022, what kept us from having a recession in 2018, because while things were rough, nobody really lost their job. And that's not going to be the case this time around, unfortunately. So I still believe what we see on Friday is going to be very consequential with the jobs number. It'll tell us whether or not this tariff stuff already started to impact hiring and firing in the month of March. My concern is that it probably did. And then we're going to get 2 weeks from now, we're going to get all these earnings calls. And I'm telling you, the forward guidance is almost going to be like a Saturday Night Live skit. There's absolutely nothing most of these companies can say because they don't know enough to have an opinion. So it's a really tough time. It's not a clearing event. And while opportunities are being created by stocks falling, there might be better opportunities later. We are in a downtrend, in a bear market, and people need to behave accordingly.
Joe. So Josh Brown making the argument here that the level of, and we'll finish that clip in a second, but the level of volatility we're getting from these tariffs is equivocating to a bear market. Now, Josh Brown also said today in a previous podcast that his firm's strategy, because he's a wealth manager, has basically been 100% stocks for the past year and a half or 2 years. So since, but yeah, basically 18 months. So October 2023, they've been pretty much all stocks. About a week ago, they switched from 60% stocks to 40% bonds. So 60-40, 40% treasuries, 60% stocks. And that has been primarily because of uncertainties. So in the midst of all the pain we're seeing, the downtrend that we're having, I think the sort of the thing that changes this or keeps it on a downtrend is if we get some certainty from the uncertainties, which is essentially what Tom Lee said today. If on April 9th, we start to see some reversals, we start to see some deals, we start to see Mexico, the EU, Canada try to capitulate a little bit, or maybe the United States capitulate, whatever it means, then we have more certainty. But what we were supposed to get yesterday is certainty, and we got a lot more uncertainty. And as a result of that, that's the reason for why he believes that we are in a bear market right now and why he thinks we're in a downtrend. I think that could change on a dime. The question is going to be if that actually ends up changing. We got Peter Navarro on CNBC right now. This is one of the White House officials who has said that we're going to get a lot of money from tariffs. Let's get his thoughts right here and see how he's justifying these current rates that we have on tariffs.
Today, I have the reciprocal tariff calculations here. It's a very fancy looking formula, but a number of economists and media pointing to a much simpler mathematical equation. They say that it looks like the administration took the trade deficit for the U.S. in goods with a particular country, divided that by the total goods imports from that country, and then took that number and divided it by 2 to get to what the U.S. plans to implement on these 60 different countries. Is that the case?
All right, let me explain what the reciprocal tariffs are. What you have is...
Real quick, before he gets into it, Ryan Cohen just bought 500,000 shares of GameStop. CEO of GameStop just bought 10.8 million. The stock is up 3% after hours. This is the first purchase we've seen in a very long time by Ryan Cohen. Obviously, they just diluted shareholders by a couple billion to buy some Bitcoin, but he just made a purchase of about 500,000 shares.
An issue where the rest of the world, by the very rules of the World Trade Organization, cheats us through significantly higher tariffs and massive non-tariff barriers. So the significantly higher tariffs we face is an easy calculation, which all you need to do is look at the differential between what's called the most favored nation tariff rate for us, which is around 3.5%, and the MFN for other countries, which varies pretty widely. Generally, other countries have higher tariffs on us, 2, 3, 4 times or higher. And we're talking about the EU, we're talking about India, Japan, Korea. So we're in a world of unfair trade institutionalized by the WTO. So the issue is, how do you capture all of the cheating that takes place in the non-tariff barriers? And let me just say what those are so people understand how you go about thinking about this. You've got currency manipulation, you got VAT tax distortions, you've got export subsidies, you've got dumping, you've got counterfeiting, you got intellectual property theft, you got these phony technical standards, you got these phony agricultural standards. And when you add all that up, you get weird things like Japan. 95% of the cars on the road in Japan are made in Japan. They have relatively low tariffs, but it's almost impossible to sell a car there. Germany, autos, they sell 6 to every one we buy. Their tariffs are 4 times higher. Plus, they have the VAT and the non-tariff barriers. So here's the thing. Punchline, bottom line. Each trade deficit we have with each country based on the flow of imports and exports and how much we actually trade for them represents the sum of all cheating. The trade deficit is the sum of all cheating. And what you simply do is calculate the tariff rate, which would be required to eliminate the trade deficit. And this is a national emergency based on chronic, massive trade deficits, which cost our jobs, our factories, and transfer our wealth to other foreign nations, and therefore threaten our national security, economic security. So that's the way to think about it. It's actually quite simple. Now, the calculation itself is based on very sophisticated analysis in the trade literature for decades, and it relates to what's the various import, the elasticities, things like that, coupled with what happens to the currency. And when you get that out, you get a formula, you get a rate. And I want to stress here that the rates we got from that are basically represented based on the sum of all cheating done against the American people. There's no dispute that we get cheated. And then the president was very kind and lenient. He took half of that.
But Peter,
and they're customized to each country. So that's exactly what happened.
I don't think anybody's arguing that there's unfair trade practices, or, to use your term, cheating happening. But there are question marks about VAT tax, which is not necessarily a non-tariff trade barrier. I realize you can start getting into the argument around what VAT taxes, the money they raise goes towards domestic subsidies, but it's not actually considered a non-tariff barrier. So it raises the question. It raises the question.
Hang on. Let's focus on the VAT for a minute. You raised an interesting point.
He's not answering the question. She asked specifically about the formula to come up with these percentage rates. He doesn't have a single answer. No one has an answer. Every economist that I read their equity sell-side reports today, or their macro reports today from Goldman Sachs, JP Morgan this morning, none of them know how you got these numbers, or the way they got these numbers is what we talked about in the morning, the imports over the trade deficits, which makes no sense. Everyone knows it makes no sense. And so this is the part that's giving the market a lot of fear. It's like, how the hell did they come up with these numbers, and how did they think the market would take these numbers seriously? It reminds me of when WeWork filed to go public. Like, no one took their S1 seriously because they had something called, quote unquote, creative accounting. Like, no one believes this right now. And the White House is not doing a good job getting people to believe that this is a legit way to impose tariffs.
And I love, by the way, I was watching CNBC this morning, and there was this fascinating debate between Steve Leisman and Rick Santelli about precisely this issue. Now, I'll tell you historically that the United States, going back to the 1970s in the GATT area, has repeatedly tried to get relief from the WTO. The problem is that our income tax system is treated very differently under the rules of the WTO, and that leads to massive distortions in terms of flows of trade and where companies go and things like that. So when you say that the VAT doesn't matter, we have tried repeatedly at the WTO. They've said no relief for you, and that's part of the bigger problem. The WTO screws us every time we try to resolve a dispute over these non-tariff barriers. So please don't tell us that the VAT doesn't matter, because there's 30 years of history that says it does, and 30 years of history that says these people refuse to give us any relief. And here's the problem.
I hear you.
Go ahead, John. Go ahead,
I want to go back to the trade deficit issue, because that's a big one. You've called this a national emergency associated with chronic and massive trade deficits, meaning that we buy more stuff from these other countries than they buy from us. We're a rich country. We got people who can afford to buy just about anything. We also have companies here that make expensive things. Why is it reasonable to expect that poorer countries, poorer people in a developing country should be buying expensive things from us in perfect balance with the cheap things we buy from them?
Okay, let's first observe that our trade deficits are not with the poor nations of the world. We have them.
But almost everybody's poor.
The nations of the world, we have China, the 27 countries of the EU, Japan, Korea, Thailand, Vietnam,
we're doing better than Vietnam,
India.
though.
So, okay, but here's the point, sir, and this is basic economics as well. Every economist will tell you that under the rules of free trade, it's impossible for a country to run chronic trade deficits for so long. What's supposed to happen is market adjustments and currency adjustments, yet we do that because they cheat us. Do you know how much money we have transferred since China joined the WTO in 2001 to the rest of the world in terms of our assets? $18 trillion. That's 60% of our last year's annual GDP of land, farmland, buildings, apartment buildings, assets, companies that have gone to the people who take that debt. So, the beauty of this is everything's on our side on this. There's no dispute that they have higher tariffs and non-tariff barriers. There's no dispute that we should not have chronic trade deficits.
Right.
And there's no dispute that what we're doing is fair and reasonable. Now, in terms of how the market, I'd love to talk a little bit about the markets, because I see, look, folks, just so folks know watching this show, I was a CNBC contributor, right, going on 10 years. And my specialty was macro and talking about technical and fundamental trading and how you had to use the two. And you look at the market, the technicians are saying we're probably at or near bottom. They're probably right. But fundamentally, I mean, let's think about
I guess that depends on what happens next, but okay.
Yeah, let's talk about the fundamentals. Let's see what we're looking at here. We've had already, and we're just getting started, $3 trillion of investment promised to come into this country. That's 10% of our GDP, more or less. That's good, and we're just getting started on that. So that's happening. Now, yields are going down today. What does that mean? Mortgage rates are going to come down. That's going to happen.
Again, referencing these yields, I asked Tom Lee about this, and he said the White House can play this game. They can get stocks to crash to get the yields to come down. But if they force us into a recession, it doesn't really matter if yields come down at that point.
Have a nice bounce for our housing sector.
It could mean people are afraid of a recession.
Gas prices are coming down. And by the way, I would be remiss in saying to you this, sir. Every single dollar that we're going to gather from the tariff revenues from foreign nations exploiting us is going to benefit the American people and American companies in the form of tax cuts and debt reduction.
Let me get another question.
In and of itself is going to be beautiful.
On this, especially when it comes to our traditional allies. Now, in your explanation of why these tariffs are necessary, you do talk about IP theft, currency manipulation, dumping, other non-tariff barriers being worse than tariffs. I don't think you would argue that, for example, Israel is guilty of those things. So if the goal is to correct those things, why is the Trump administration inflicting economic pain across the board, including on our closest allies who otherwise might have been partners in addressing these issues?
I would argue that Israel is part of that. They steal a tremendous amount of intellectual property from our pharmaceutical companies. And there's a tremendous amount of disputes. They have enormous tariffs on our agricultural products. So when it comes to trade, we have no friends. We have people who are trying to exploit our markets. And if you just go through some of the list, I mean, Japan, look, Japan's a great ally in terms of geopolitics and strategy. But why is it that 95% of the cars in Japan are made in Japan? And meanwhile, they sell us 100 cars for every one we sell them. It's because of their non-tariff barriers. We try to sell some nice Louisiana rice to Japan. There's a 700% tariff on that. Same with South Korea. Vietnam. I love Vietnam. It's a great economy, but it's become a colony of communist China. They sell us $14 of stuff for every one they sell them, and it's because they've got warehouses full of communist Chinese products that they strip off the China labels, put on the Vietnam labels, and that comes here to avoid the tariffs. In Germany, look, Germany, they came over here to build cars, BMWs and Mercedes. What do? We're their colony. We assemble them in Spartanburg, but every engine and transmission comes from Bavaria. Think about that. So this is what President Trump sees, and this is what the American people elected him to do. And look, and when we get to the other side of this, and it's going to happen very quickly, it's going to be beautiful. The guy who almost stole the show yesterday in the speech, nobody ever steals it from Trump. But Brian, the UAW worker, came close when he explained there's he saw all these empty factories.
Before we let you go,
they're going to be filled up.
Before we let you go, given everything you just laid out and this restructuring of supply chains and basically the global world order and America's role in it, how negotiable are these tariffs? What does it take for countries to actually negotiate the tariffs that were just announced yesterday?
Let me make this very clear. This is not a negotiation. This is not that. This is a national emergency. And I watched.
See, but that just doesn't make any sense. This is the scary part. What he just said right there is very scary. Because when he says this is not a negotiation, this is a national emergency. Tom Lee was on the show an hour ago, and he says, no, I think we'll get some negotiations. Dan Ives said, no, I think we'll get some negotiations. Like, the entire reason I think Tesla and Palantir are not down like 20% today is because they kind of think that we'll be able to negotiate against some of these rates. But when you have him and the press secretary this morning say, no, it's non-negotiable, what is the market supposed to do? And that's why no one can be angry that the market's down today, because the market's simply saying we're putting our hands up in the air. We don't know how to price in anything when they're saying the one thing we thought theoretically could happen, which is you get some deals done, now are not up for negotiation. That is the scary part about what these White House officials are saying right now.
A commentator today on another network who came from South Carolina, who said very clearly, well, if we're going to have somebody come here and invest in a textile plant or an auto plant or whatever, they're not going to do that if they think the tariffs are going to go away tomorrow. And the reason they can't go away tomorrow is because the bigger problem is the non-tariff barriers. You think that the European Union is going to give up their protections for farmers, their protections for the tech companies, their VAT tax tomorrow? That's impossible. So these tariffs are here to protect America. They'll raise revenues for the External Revenue Service. They'll restructure not just our economy, but our tax system.
Okay.
And Americans will benefit from every single dollar we raise.
All right, let's get to Dan Ives. He's on CNBC and get his thoughts as well.
Of the tariffs, but by what happens to brand America around the globe, where even the software has to be sold. No?
Yeah, I mean, look, it's essentially an economic Armageddon. You know, if these tariffs stayed in place, and the reality is talking in front of a microphone in the 202 area code is a lot different than the reality of moving the supply chain. And I think it speaks to our point that when you look at China exposed names from NVIDIA to Apple to any of the semi names, I mean, this is as nervous as I've seen investors going back to, you know, COVID, March 2020.
So what do investors need to listen for on these earnings calls? What are the fundamental numbers to watch, perhaps when it comes to margins getting squeezed, to understand what the real dynamics are going to be throughout the rest of 25 and where you can continue to get a valuation premium?
So I think there's three things I think you have to look at. One, I mean, Navarro talked on negotiations. You have to assume that these tariffs don't hold in their current form. If they hold in their current form, then essentially you have 15 to 20% demand destruction across the board in terms of costs that are actually going to have to come through. And to that point, I don't think a lot of companies even give guidance on their 1Q conference calls, given, you know, what we've seen in terms of the head scratching tariffs. The thing that you really have to focus on in terms of like what demand destruction looks like in terms of when it comes to AI revolution, data center build out, inventory. And then of course you start looking at consumer focus, names like Apple in terms of what that means for iPhones. The reality is if you want an iPhone made in the US and you want that for $3,500, we should make it in the US. If you want it for $1,000, you keep it in China. So I think these are all the issues that investors are trying to sort of game out.
So in light of that, I'll just use Apple as an example. There's just this automatic assumption that any kind of price increase tied to 54% tariffs on goods imported that have been made in China, iPhones perhaps included in that, is going to be pushed out to consumers. Is that actually going to be the case, especially if you look at an Apple that has pretty robust margins and maybe is going to absorb some of that cost?
Yeah, Mark, if it was a smaller tariff, that's something that maybe that they can absorb. But these are numbers, I mean, that are, I view as absurd, and I think many view it across tax. So there's only, whoever's going to pay it, it's the consumer. And that's the reality. You can talk about tariffs all you want. Consumers are going to pay it on iPhones. They're going to pay it on electronics. They're going to pay it across the board. And that's really what you're seeing in terms of self. I think right now, tech stocks, you look at a name like Apple, essentially baking in numbers cuts, 12, 15%. And margin erosion that could be more. So our view in terms of how we're navigating this, very similar financial crisis days, COVID 2020, is that you have to look on the other side, assuming some sort of normalized earnings into 25 and even 2026. And those are the names, whether it's Microsoft, Apple, and some others. That's how you navigate in terms of, you know, looking at the scenarios in terms of how these play out.
It's interesting because we did get exemptions on semiconductors in the midst of these tariff announcements. But the other area, another area of the market that was very defensive today and held up relatively well were defense contractors themselves. Now, I realize not necessarily the case for the Palantirs of the world, but in general, when you're talking about some of these types of companies that are exposed to government revenues that maybe are a little more domestically focused in terms of the stacks they've built out, is that a place to be investing right now?
Yeah, I mean, and I think Palantir and others, but if you look at Lockheed and some of the primary, yeah, no doubt, those are ones that held up, I think, a lot better in terms of defensive, but I think devil's in the details. Because the reality is when you look at the implementations, you look what comes from foreign perspective, you're talking 40, 50%, a lot of these implementation from a hardware perspective and others. So that's why our view is like what, and to your point, John, is like what are the second, third derivatives? What's the ripple effect? What the demand destruction is? I think investors, if you look here, these stocks are baking in recession into these stocks. If you think it's anything better, and you're basically saying some sort of game of high stakes poker, and there will be negotiation, then these are the names that you ultimately buy. But look, it continues to be, if these tariffs stay, we've said in tech, it's an economic Armageddon.
All right, economic Armageddon. Dan Ives, Wedbush, thank you.
Trump just gave some comments to reporters, probably on Air Force One. We don't have the video, but let me pull it up right here. Dan Ives basically saying what Tom Lee said and pretty much echoing his note this morning about how these tariffs would not be the best thing in the world. So Trump says, okay, he said a couple things. He said, tariff operation is over and markets will settle. Then he said, I'm open to tariff deals if the offer is phenomenal, aka they're open to negotiations, even though his visors say that they're not. He confirms China talks on TikTok, visiting Russia. He talked with Bibi Netanyahu today, and Elon Musk may leave in a few months. So we got a handful of different headlines right there. He says the tariff operation is over. He's open to deals if the offer is phenomenal. He confirms they're working on TikTok, talked to Israel and Russia today, and then he says Elon Musk may leave in a few months. Okay. That's what we got. What a day. What a freaking day. This is winning. Okay, here's a question. Who thinks we bounce 2% tomorrow on the S&P? Who thinks we bounce? Like, because if we have another negative 1 or 2% day after today, then it's like, all right, it's just ugly. Like, it's just bloodbath ugly. The bottom's falling out, essentially, and we're down another 0.5% after hours across the board. Q's down about 1/3%. I wonder if we bounce. I wonder if tomorrow, and again, what would the logic be? Well, it would kind of just be like a technical retracement. All right, we bounce back up, but I can understand anyone voting no because the uncertainties have not become any yet certain than they are right now. And so if they continue to be uncertain, then yeah, obviously I don't think we need to bounce, even if we don't need to necessarily go down. Don't we have news? Oh, I forgot. We have freaking JPOW tomorrow. Yeah. We got the initial jobless claims today. We got ADP private payrolls tomorrow. Is tomorrow non-farm payrolls? Hold on. Let me make sure. I think tomorrow's non-farm. Yeah. That plus JPOW. That could give us a bounce. It could also give us a nice little decline as well. It is also a Friday. People might not want to hold through the long weekend. Tomorrow's April 4th. Yeah, we get non-farm payrolls. The market wants 135,000 jobs, and we get the unemployment rate. The market's expecting 100,000 jobs and 4.2% on unemployment. And then we get JPOW talking. So tomorrow's a packed morning. All of that put together probably is going to impact the markets. Carlos, thank you for the $20 super chat. Appreciate it, brother. Amit really means who bought the knife. Yes, exactly. Which I bought the knife today. So there you go. Thank you, Carlos, for the super chat. Really appreciate you. Thank you for being here today. Yeah, tomorrow's gonna be interesting. 58% of you say no. We do not bounce 2% tomorrow. JPOW's at 11:25 a.m. I'll be live. JPOW's at 11:25 a.m. Eastern. And we'll see what he says. Are you still moving out? Dude, I hope so. I hope this market doesn't collapse to the point where I'm like, kind of don't want to move out anymore. No, the plans to move out are still on. The one update I have for you guys is that my grandparents are coming from India for June and July. So if I'm going to move out, the earliest I'm moving out is August because I'm just going to have to be home June and July. Grandparents are getting older. They haven't visited America in a long time. So That is happening. So the earliest I'm looking is at August. I still don't have a place yet. I'm ferociously looking every single day, calling these agents every single day. I don't know. We got to see. Plan is to still move out. Hopefully we don't enter into a disgusting bear market. But even if we do, I'm pretty convinced I'll be moving out in the past couple months. Maybe I don't want to get as aggressive as an apartment that I was thinking of getting if it gets that bad, but more likely than not, yeah, we will be moving out. But August seems like the best time. Also, I mean, it seems like July is going to be a lot of traveling along with June. So it kind of just doesn't even make sense to move out anytime before August because I'm just not going to be home for basically for the entirety of the summer here. Amit moves under a bridge if the tariffs go on. Oh my gosh, bro. This is crazy. It's aggressive. It's an aggressive drawdown. But it's happening. Are you taking all the bricks with you? Yeah, dude, we got to take the bricks. There's no way I can continue this show for the coming years if I don't have the bricks. At this point, it's a staple of the background. So we'll have to be bringing these bricks as well. Dude's going to be living in a mobile home. Oh my gosh. Don't rush it. Well, dude, I've been waiting for like 4 years now. And I think it's been the smart thing to wait. I'm 27. I want to move out before the end of the year. Stayed home for the past 5 years now. I think it's time. Obviously, you know, the market impacts me just like it impacts everybody, and that'll definitely impact my decision here. But regardless, I think it's time to move out now. So we're gonna see how bad this gets, bro. But look, that wealth effect is real, right? I mean, I felt a lot wealthier 2 months ago than I do right now, and I'm pretty sure everyone feels the same. I'm just kind of betting that this is not the type of cataclysmic, catastrophic recession, given the other parts of data that I'm looking at outside of the stock market prices currently right now. But obviously we're going to find out. Can JPOW do anything to save us? Yes. What JPOW can do is say that they are more likely, not literally, but will infer, to cut rates. The problem is, again, this is the weird part, dude. If he says it's time to cut rates, or if he implies he's going to cut rates in May or even June, I don't know how the market's going to think about stagflation and this concept of growth slowing down, but inflation going up if tariffs are inflationary. If we already have less restrictive monetary policy, we will have a surge in inflation. That's just mathematically, that's how it would play out. Unless you think that inflation by itself is coming down so much because of whatever reason that JPOW might cite, shelter, consumer confidence, yada, yada. And so like that could save the market, or that could help save the market. But if the market then is saying, okay, we're getting rate cuts and JPOW's too early, which would be a flip from the narrative. Everyone's saying JPOW's too late. But if you think the tariffs are inflationary, JPOW might be too early. It's a really hard market to navigate, right? Because everyone's like, including myself, JPOW's a bit late on the rate cuts. Like, we should be cutting rates. But if you have these massive tariffs being imposed across the global economic spectrum, you're going to have some more inflation. Like, it's undeniable. And then why are we cutting rates if that's the case? Also, the labor market is not recessionary at all. So why would we be cutting rates from a labor market perspective? There is no reason. Why would we cut rates if the tariffs are going up? There is no reason. So we probably don't cut rates, which means Trump, I think, is more in charge of the stock market than JPOW right now, because I don't think JPOW is going to cut rates. Yeah, not according to Trueflation data. Agreed. However, the Fed doesn't look at Trueflation. They look at the BLS, which is the problem, right? And so, you know, they're not going to look at Trueflation as a barometer to say that they're below their target, which means that if I was a betting man, I would say we're not cutting in May, unless it really does get that bad. And then JPOW's like, you know what? It's time to help save the market and risk stagflation. But the one way you don't risk stagflation is growth comes down so much that inflation comes down, that then if you cut rates, even if you're not as restrictive in monetary policy, you don't have to worry about inflation increasing because growth is decreasing, which will get inflation to decrease as well. It is a very, very wonky market to try to be able to navigate. Yeah, Intel, TSMC. So let's take a look at that headline. I've not read into any of this. If anyone owns these two stocks, let me know. But Intel, okay, so Intel and TSMC tentatively agree to form chip-making joint venture. Intel's financial crisis may be over with support from its biggest rival. Executives from Intel and TSM recently reached a preliminary agreement to form a joint venture to operate Intel's chip-making facilities, with TSMC taking a 20% stake in the new company. So this would be a spin-off, according to the information. And some Intel executives are reportedly concerned it could trigger mass layoffs Intel already had mass layoffs last year of about 10,000 jobs. So if they form this new venture, theoretically that could be good, but it might not be the best for jobs, according to the information right here. All right, so that's what you got in terms of Intel and TSM. Let's look at stocks after hours. Tesla down another 0.2, Palantir's up a little bit, Robinhood's flat. Newsmax is down 5% after being up 18% during the day. Again, just weird, bro. Just does not make sense. Meta right here down about 0.2. Nvidia's up a little bit. S&P is down another 0.1. Q's down 0.2. Carnival down 0.02. HIMS is down 0.64. HIMS down 10% of the day. Amazon up a little bit after being down 8.98. And then Google down a little bit after being down 4% on the day. Oil is down as well, which is actually great for inflation and technically really good for equities. Oil was down. Wow. WTI down 7% of the day. Brent crude down 7% as well. Now, we can't get oil to fall too much. Then we are sort of guaranteeing a recession. Oh, OPEC increased supply today. That could have been one of the headlines. I think I did see that headline at like 7 a.m. or something. But that's good. That's good for equities, as input costs will come down because of that. Yeah, OPEC agrees to make a larger than expected supply hike in May, adding the equivalent of 3 monthly tranches of its previous plan to revive output. All right, that's not horrible. That is not horrible. Broadcom right here also down about 10% of the day. It's up a little bit after hours, 0.12%. This Deloitte headline I saw as well. So it looks like Deloitte is firing a ton of government consulting, is laying off consultants after the government has cracked down on costs. I wouldn't be surprised if Booz Allen Hamilton and Accenture do the same. There's a lot of government consultants that work at Deloitte, KPMG, Booz Allen Hamilton, Accenture. One could argue that a lot of these contracts they get from the government aren't really that valuable, and we're kind of paying them to do nothing. So it does make sense that they're probably engaging in some layoffs, but that also goes to show you the economic ramifications of DOGE, which is that when the government stops spending, which is, again, partly the reason a lot of people felt that 2024 and 2023 were so good, is because the Biden administration spent so much money. When the government stops spending, there's a downstream effect on private companies that are also going to stop spending. And that could obviously lead to earnings declines as we get more layoffs. It is a very, very, very nuanced market to be able to operate right now. What about SoFi and Hood? Yeah, both of them got hit today. I mean, I saw some chatter today that SoFi and Hood shouldn't be down 10%. I disagree. I mean, like, yes, these guys aren't selling things that are, rooted in tariffs, but Hood is based on trading volumes. That's going to go down if the market goes down. So Hood's going to get sold off on that. And then same thing with SoFi. I mean, like, you're not going to get that many people excited to take out a personal loan unless rates significantly come down, which maybe that's a catalyst for them, but then you've got to make it up with volumes. And then B, like, in general, how much economic, SoFi at the end of the day still is a bank, and banks benefit when capital expenditures are actually flowing through the equity markets and through the private markets with M&As and IPOs. And so all the financials, along with JP Morgan, Bank of America, they got hit today as well. SoFi just being a little bit more high beta because it's a growth stock, heavily retail owned. It makes perfect sense to me why it's down 13%. Do I agree that it should be worth $10.64? No. But I can't blame the market today taking them down. I can't blame the market taking Robinhood down 10% either. Do you still think Hood is $100 by Jan 2026? No, I think if Hood gets to 100, it would happen in 2027, not in a year, unless we get, the most V-shapes of V-shapes you could imagine. For Hood to double from here, or for Hood to even get back to those $65 highs, we got to get back into a bull market where people are incentivized to trade and they're excited about putting money into Robinhood and spending it. That means that you've got to assume that we are still in a bull market, which I think we don't necessarily know yet. But I think if it were to get to 100, which is like pretty aggressive on Hood, it would be 2027 at the earliest, if that, right? We've got to have a great 2026. And the problem is 2026 is a midterm year, and historically midterm years are not good. Midterm years suck. Like, they're not fun years in the stock market. 2022 was a midterm year. So it's one of those things where I think we're going to have to navigate in regards to how bad the midterms actually end up or how bad 2025 leads into 2026. Dan Niles just had a quote. He said he doesn't think Jerome Powell and the Fed will cut rates this year. You know, I can't necessarily blame Dan Niles for thinking of that. By the way, I mean, he's been correct all year. Cash has been a better position than a lot of equities, which was his number one position. And the reason he probably said that Jerome Powell and the Fed won't cut rates this year is because if tariffs are massively inflationary, Jay Powell's not going to cut rates. He's not going to do it. He's going to think we have too much inflation, and he doesn't want stagflation. He doesn't want any aggressive inflation entering into the broader markets by restricting monetary or by alleviating the restrictions on monetary policy. So it makes sense that Dan Nile thinks that. We also got another headline. The European Union is considering fining Elon Musk's X more than $1 billion per the New York Times. Per the New York Times. Wow. The EU wants to fine Elon's X $1 billion. I don't know what the reason is behind it. Why are they fining him $1 billion? I don't have the reason why, but that's the headline. European regulators are considering fining more than $1 billion after weighing the risks of further antagonizing Mr. Musk and President Trump. Huh. Well, yeah, a little bit of a hidden tariff, right? There you go. This might be part of their way to get back on the reciprocal tariffs. They're going to put, well, you know, Chris made a great point this morning. The biggest thing the EU can do to America is tariff or put a services tax or make life a little bit harder for our tech companies, because our tech companies have great margins. They export a lot of value to the EU, Meta, Google, Amazon, etc. And if you tariff them, A, they can afford the tariff. They're not going to like the tariff, but because tech companies don't deal with physical goods, they can afford it. But B, it definitely hurts their margins, and it definitely will hurt shareholders. So one of the ways the EU can get back at American companies, even without imposing a legitimate tariff, is just taxing a services tax, is what it's called, on tech companies. And obviously, Meta and Google, Amazon, they're going to have some hard decisions of, do they leave the EU? Do they pay these taxes? How do they navigate it? And you know, putting this $1 billion potential fine on Elon is another way to navigate it. Dude, 2025 is going to be very interesting to see how this plays out. Very, very, very interesting now that we have all these different variables in the mix. We talked about the Trump TikTok headline. He says, I would consider a deal where China approves TikTok sale in exchange for tariff relief. Okay, so that's actually a little bit more clarity than what we talked about before. The headline is Trump says if there, so he's using TikTok right here in negotiations for tariffs, or at least that's what he's saying he would do. I actually thought that would happen. Maybe China approaches him tomorrow, and because the deadline is April 5th, so they got to get a deal done soon on TikTok. Or maybe he extends the deadline for the ban, but maybe that's a pawn in the tariffs. Gene says, I'm going for a walk, too much red. I think everyone should go for a walk. First of all, at least it's great weather on the East Coast. It's not that bad. So if you're on the East Coast in the United States, you should go for a walk. But if you're anywhere out there where you have something you can do to distract yourself, a walk to me is one of the best things. But I think it's one of those days to go on a walk, dude. But it's also one of those days, in my opinion, to not freak out. To not freak out. As ugly and disgusting as it is, I still feel that these are the days where you take a little bit of a nibble and just see how it plays out. Eventually, we will get through this. I don't know how we're going to get through this, what it's going to look like. We'll be here every day to navigate it. But I think eventually we will get through it. And I also think it's a very toxic mentality to feel like you should have been perfectly hedged, or you should have sold the top, or yada, yada. I mean, like, if you feel like that, then you should open up a hedge fund, because people will pay you a lot of money to aggressively hedge a portfolio and still outperform the S&P. Most hedge funds don't outperform the indices because they're so hedged that their losses offset their profits offset their losses, and you tend to not beat the S&P 500 when you're that hedged. And B, a lot of people will pay anyone a lot of money who can sell the top and buy the bottom. So I think feeling bad about not being in that situation is just like a waste of mental energy, because most people can't do that. Bank of America was down 11% today. Really? Was it? Wow. I didn't see that. Wait, so how much was JP Morgan down? I thought they were only down like 3 or 4%. That means Bank of America was down as much as SoFi. JP Morgan was down 7%. Yeah, now I mean, like, dude, that's your explanation for SoFi being down 13%. If the big guys, if the biggest banks in America are down 10%, yeah, SoFi is not going to be able to hold up either. Let me ask you, Amit. We knew Trump is going to announce tariffs on April 2nd, and we know market will react badly, meaning down. How can someone buy stock ahead of that time? Well, again, the argument here for why you would have bought stocks yesterday is that you believe that the market has priced in the worst of the tariff volatility. And for the first 15 minutes of the Trump press conference, that was correct, because the only detail we got was 10% across the board. That was less than the 20% the market expected. Stocks went up. And because the market is always about forward expectations, the market could mathematically model out 10% tariffs and they could move forward. But this whole whack-a-mole game of India gets 50 and China gets 30 and Indonesia gets 25. It's like that. No one. I mean, there was not a single leak for the past 3 weeks of that being the de facto policy. And I think the reason for that is because they came up with it. I'm being hyperbolic here, but you get the point. Came up with it 10 minutes before they went live. And that's why it never leaked, because no one knew that it was even happening in the first place. And as a result, I think that's why people bought stocks yesterday. But right now we're seeing the fallout from those stocks. Toby says, I think we tried to call Trump's bluff and failed miserably. Yeah, exactly. I mean, anyone who bought stocks yesterday, including myself, if you tried to call his bluff, which wasn't really a bluff, it was more so you tried to make the argument that Trump wouldn't be as crazy as you think he is on this tariff announcement. And for the past couple of days, I think the nuance to what I've been saying is like, hey, I think it's priced in unless Trump says some crazy shit. And he said some crazy shit. Like, he just said some crazy shit. And that's why we dealt with that pain. Let's listen to Brad Gerstner on Tesla and how he's navigating that right now. And then we'll keep going from there.
You told us exclusively that you had sold Uber and that you had bought Tesla, thinking that the game had changed in the big picture. I'm wondering what you think about that now, if your position still exists. Obviously, the tremendous amount of controversy around Elon Musk, his role in the government versus what he, according to analysts, should be spending more time on, that company, as the stock has just gotten hammered.
Yeah, listen, we weren't big in either of these names, as I said at the time. I think the big news, Scott, was that I was a long-time and large shareholder of Uber. And starting in the spring of last year, when we saw full self-driving, 12.3, and then by the end of the year, 12.9, we just knew autonomy was here. And, I have a new Tesla Model S I bought in December. It drives me everywhere. I tweeted about it the other day. I don't touch the steering wheel. I think it's quite extraordinary. In fact, I think Faber tweeted something or said something on air that got tweeted over the weekend about how he experienced it. And so I'm absolutely convinced robotaxi is coming. It's coming from Waymo. It's coming from Tesla. And it's coming from others around the world, and many in China. That Uber is partnering with around the world. And I think this does pose a risk fundamentally to the Uber business model. Now, listen, Dara Khosrowshahi, he's an amazing CEO of that company, is taking the steps necessary to forge the partnerships around the world. They've announced partnerships with several companies in China, and companies outside of China. I just don't have the confidence yet that that is fully come together and is really going to be able to stand up to the full stack solution that Tesla has. We're not big in either name today, right? Tesla has its own challenges with the global recession.
Josh, let me interrupt you, because I really want to make sure the viewers get your take on this. I'm of the opinion that the consumer wants the lowest price and the fastest pickup when they summon any ride-hailing situation. If you go on the Tesla app because you're into Tesla or you love Elon Musk or you care about the battery or whatever, and it's 13 minutes away, isn't it more likely that you won't do that a second time? You'll start off on an app that has both autonomous and Teslas and everything else, and you'll get the fastest ride for the lowest price. And if you agree with that, would that explain why Tesla is down 35% year to date while Uber is up?
Yes, I think it's a very fair point. Listen,
Thank you.
I think if you look at it, in the full arc, We sold our Uber closer to $80 a share. And it bottomed at 60. It's now back to 70. Tesla's down a lot. Like I said, like net, I'm happy with the way we managed those positions. And I still think we're in a place where we can't really definitively answer the question. We do know that Tesla is going to launch a really great solution. But to your point, Josh, if they don't have speed of pickup in Austin when they launch in June, and if they don't have the lowest price, then there is no market for them, right? Waymo and Uber are already there, right? And that's what this game is about. It's about price and it's about convenience. But we've seen Waymo gain tremendous market share in Los Angeles, in San Francisco. The net promoter scores are even higher than a ride with a human in them, right? We see parents all over San Francisco that are getting their kids to after-school activities in Waymos with no drivers. They actually prefer it to an Uber with a driver. So I believe that autonomy is here. I believe that we're going, the technological challenge of full self-driving has been cracked. I think Tesla is in a great position on that, but they have to execute, just as you said. Waymo's in a good position on it, but they're still subscale. And the real question around Uber was, can they find the partnerships and solutions that allow them to compete with Waymo and with Tesla? And I will tell you, I just met with the company the other day. I have more confidence today that they're moving in that direction. We actually have a small slice of Uber in our portfolio today that we've added right over the course of the past few weeks on some of these pullbacks. But again, I just want to say very clearly, our position sizes are small. We're heading into what could be a recession that could dwarf all of these debates. And secondarily, I don't think it's clear either way. Josh, you and I can't say definitively today which model is ultimately going to win. We have to wait and see what happens with Robotaxi in June and how this unfolds over the course of the year. But, listen, I wouldn't count any of them out today.
All right. So Brad still bullish on Tessie, even though obviously rough delivery numbers and a pretty rough day for Tesla stock, even if it's holding up, still thinks it'll have more potential than Uber. All right. I think that's it for the show today. Thank you, everybody, for joining. If you're just tuning in, the Tom Lee 30 minutes was at the beginning of the show, so you can just rewind. I'll have the chapters in the description. But yeah, thank you, everyone, for joining, and thank you for listening. Tom Lee was super awesome, spending 30 minutes with us in the beginning of the show. And he gave some good answers in the context of bond yields, the tariff rates that are being imposed. We talked a bit about Tesla. I guess he's just as confused as everybody else on essentially if this market is going to have the current tariff rates that we still have right now. Highlight of the day was Amit's refill for the Saratoga bottle. Dude, it's hard to take the freaking cap off this thing. And now it's off here, but like it was in the morning, it was tough. Everyone's saying I'm sponsored, dude. I am not sponsored. I'm giving so much free publicity to this brand, but I'm not sponsored. I just wanted to hop on the trend. But no, I don't think they're sponsoring a financial YouTuber. But yeah, look, I advise everyone to really go out if it's good weather. Try to go out, go on a walk, go on a swing set. I know that might sound kind of stupid, but like, you're never too old to get on a swing set. You're never too old to get on a swing set. You're never too old to get on a swing set. Not at all. You might look kind of stupid as like a almost 30-year-old guy or 35-year-old person or like 40-year-old person on the swing set, but like it's a swing set, dude. Swing sets are universal. So yeah, I would just take your mind out. Go watch a good show. Go walk outside. I mean, these are the days. Again, if you're not maxed out on leverage and you don't have to actually actively manage the portfolio because like you're not going to get a margin call or something where you have to deal with it, kind of just put it away and move on from there. Yeah, some of you guys are across the world. It's 11 p.m. for you guys. Okay, let's do this. What time is it right now from where you're watching? Or put where you're watching from. We haven't done this in a while. Where are you watching from? Where are you watching from? Because a lot of you guys, it's probably night now versus afternoon. Lakers versus Warriors tonight? Okay, see, I'm going to distract myself with some Lakers-Warriors. LeBron and Luka, that's money. Jimmy Butler and Curry. I usually don't watch basketball, but that's a big one. So I'll be watching that. We got some Torontos in the house. I'll be there soon at the end of April. Super excited for Toronto. We got some Netherlands here. We got some Norways. Yeah, it's around nighttime for people in Europe. We got Chicago's. That's also on the list this year. I think we might be able to do Chicago. So that should be on the list. Got a lot of Germany's. We got Florida's. We got some Atlanta's, Israel's, Chicago, Texas, Saudi Arabia. I love it. Oregon, Poland. We got a lot of Toronto's, dude. Wow. I love it. Zurich, Dubai, Thailand. Dude, it's so crazy, right? Everyone across the world is feeling the same like pain. Like the S&P 500 down 5%. Every one of us are staring at the same number, even if it might be in a different currency for some of you guys, and we're just seeing it go down. And I think that's a beautiful thing. I like all of us together watching ourselves lose our net worth. There's got to be something philosophically like there's got to be something soulful about that, in my opinion. There's got to be something that means something other than us losing money. It means something to lose it together all across the world, staring at the same thing. It's got to mean something, right? I'm struggling to figure out a word to come up with, but it has to mean something good eventually. It's a family. Yes, it's a family. I mean, dude, if you're going to lose money, you might as well lose it with thousands of people across the world, right? At the same time, right? Like it would suck losing money if you're just sitting in your room, bored looking at your portfolio. It sucks a little less if you're with everybody else across the world and crying together. Exactly. We got Ibiza. Dude, I want to go to Ibiza. Ibiza is obviously, just a crazy, crazy place in Spain. I would love to go there. So that'd be awesome. We got a lot of Portugals, Dubai's, Ottawa's, Sacramento's, Minneapolis. A lot of Dubai's here. Wow. Arkansas, Detroit. That's awesome. A lot of people across the world losing money together amidst hosting group therapy. I mean, yeah, we're losing money as a group. Family or cult? I prefer family. I guess you could say we're a cult in the following of the stock market. I mean, again, dude, like I know I say this over and over again, but like your friends and family don't follow the markets as much as you probably follow the markets. They're not as intertwined into looking at the candlesticks and JPOW and interest rates and blah, 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 blah. And maybe, it can drive you crazy, which is why days like this, you got to move on. But you got to remember the good days, bro. On the good days, like at the end of 2024, when you're seeing your portfolio go up literally for some people, hundreds of thousands of dollars, for other people, tens of thousands of dollars. It's like, it is one of the most magical feelings ever. It is the magic of compounding your wealth by allocating capital, which is the dirty secret that 99.9% of the world does not understand. Got a lot of smart people in the world that don't invest because they don't know what it means to invest your capital. I mean, Chamath actually had a good clip on the Olin podcast the other day. He said he talked to an NBA player. This guy was making hundreds of millions of dollars, and the NBA player went up to him and he was like, "Can you explain compound interest to me?" I mean, think about that. Someone making hundreds of millions of dollars doesn't understand compound interest. And that's not the NBA's player's fault. That's the financial education failing that NBA player from even understanding the core basic concepts of, hey, you have hundreds of millions of dollars. You should be able to compound that. And even if you get 1 or 2 or 3% a year, that's a lot of money if you're starting off with a big base. So if you even know about these concepts, I think it's just already so special. I think that's what makes this community special. And these down days, I guess, are special as well because we're all going through it, but we all go through the up days eventually as well. Fear and greed at 8. We are now below 9. Fear and greed at 8. Obviously, the market is saying that they are very afraid of what's happening right now. Doug says Amit is right. It's way more fun to lose money with you guys than it is by myself. Yeah, dude, if you were losing money by yourself, right? It's literally just you in a room alone looking at the portfolio thinking that you're the next Michael Burry. I mean, that's really what it's like, right? It's like you're developing your own bear thesis, short thesis. You're seeing everything go down. You're trying to come up with your own ideas. And most people are not going to end up becoming the next Michael Burry. But if you're losing everything together and, eventually we're all navigating and trying to put the pieces of the puzzle to see how we move forward from there, it's a lot more fun of a journey than trying to just stare at candlesticks going down and convincing yourself that things will be okay. And look, there's a lot of people out there that I think are trying to become the next Michael Burry right now. I'm seeing a lot of these overarching, almost conspiracy level bear argument theses. and they're like putting Japan in the mix and all this stuff. And I'm like, all right, I mean, look, you can try to do that. Michael Burry got it once. It's not easy to get it twice. It's not easy to do what he did. He took 3 years of a lot of shit to be able to eventually end up being right. It took a global financial crisis for that to happen. I just don't think we're there. I think the better opportunity is just being patient, DCAing, and figuring out how this plays out. And again, you don't get, I mean, like, again, it's so cliche, but you don't get the gains without going through the pain. It's in anything in life, right? You don't get to freaking be the best basketball player unless you go through the pain of losing a playoff series or being in the gym at 5 a.m. and doing 1,000 shots. Like, it just, like, you have to go through these days. It's almost the tuition that is needed to be paid and the volatility that you have to go through unless you are perfect at navigating the volatility, which, you know, there's not that many people in the world that are, and the ones that are manage a lot of money and they still lose a ton of money for their clients. So it is literally just the price to pay of being in the markets. Amit, when will you come to Germany? So I don't know. The plan was this summer, but I think this summer might just be the UK and France. It depends. It's definitely going to be France because I know Robinhood's having that crypto event. And so that'll be the reason I go across the pond. But the UK, I know a lot of you guys are from the UK. So I really want to go there. And then I know a lot of you guys are from Germany as well, but I don't know if we're going to have time to be able to do Germany as well. Part of the reason also is because again, my grandparents are coming from India. So, you know, if I was thinking the trip would be like 3 weeks, now I'm thinking the trip is more like a week and a half because I don't want to be too far away from them for too long. So I don't know. Definitely the UK and France is going to happen. I can pretty much confirm that on my side, barring any different changes. But Germany, not sure if that's going to be happening this time. But yeah, a lot of stuff is just a train away. I agree. So like, if I'm going to do Europe, I want to do a lot of places. But the UK for sure. That's definitely going to happen. So it'll be fun. It'll be super, super fun. Fair says, love you, Amit. I have seen each and every video since the first Jeremy reaction video back in late 2021, early 2022. I'm from Saudi Arabia. I love it. Thank you all for being here from the early days. It's been a long journey on YouTube. It's been super fun to build a brand, and a lot of new people have discovered the channel recently. But for those that have been here for a long time, it's been fun. It's been fun building this every day. And I think, you know, again, in the worst of days, I think that's when streaming is even more important. Like, whether you guys like Chris or not, I was re-listening back to the market open, and he was on for about 45 minutes. I think there was arguments there that were meaningful to listen to, right? And I think on a day like this, you just want perspectives. You can disagree with the perspectives, but just having some level of perspectives and analysis, I think, is important. And these are the days when it's the most important to go live. So happy to be here and actually keep doing it. All right, cool. I think that should end out the day. The daily recap will be coming out today. We haven't been able to do it for the past couple of days because the market close has been ending so late. So I just haven't been able to get the daily recap out. Should be out in a couple hours, and we'll recap everything that went on today. And yeah, then we'll keep going from there. All right, I think that's it. Thank you, everybody. Every time I'm about to leave, you ask some weird question. I feel like I have to answer it. Do you make your eyebrows? No, I don't make my. How do you make an eyebrow? It's just my barber. He just does a little magic with the eyebrows, you know, and tries to. Everyone comments on the eyebrows for some reason. Yeah, he does. He does a good job with the eyebrows. He like gets them. It's not like women do an eyebrow wax, right? Like, I don't get my eyebrows waxed. He just kind of like lines them up and gets rid of a ton of excess hair, so there's not a unibrow there. One thing about this, all right, this is what I'll leave with. One thing about this market that we're in right now. One thing that's really hurt me today. I came to this conclusion today, and I realized, like, this is really the worst thing about everything. No more $60 manicure and pedicures. Like, I don't know if I can justify it anymore, dude. Like, this market's down. It's like, I don't know. And I really, really enjoy the manicure and pedicures. So, and I started getting them like 3 months ago. It's been a habit every month to go get it. I don't know, dude. I guess they're done. Like when Robinhood, like that's 2 shares of Hood. Am I really going to give up 2 shares of Hood to have a manicure and pedicure? Like, that's what you do in a bull market. You get a manicure and pedicure. In a bear market, you make sure you hold on to whatever cash you can. Steve cannot join right now, guys. He is in a ton of meetings. I was on the phone with him a couple hours ago. He is super, super busy. He was on yesterday, though. He was on yesterday. So if you want to go to Steve, go to the market close from yesterday, go to the chapters. Steve was on yesterday. The one thing about Steve, though, is he does not care about any of this. I mean, I was on the phone with him a couple hours ago. Like, quite literally, he could not care less about the stock market being down 4 or 5%. He doesn't care. So Steve is great for individual analysis on certain stocks. In the context of the macro, I mean, the answer he would give you is, I don't care. And that's probably the right answer, but that's not, the most entertaining form of analysis. But Steve's not a macro guy. He's more of an individual stock guy. Also, he told me he did a podcast with Tanner, which should be coming out soon. Is it already out? And he told me him and Tanner got into a big debate over something. But yeah, he's not going to say anything that interesting about the macro. No, it's not out yet. Okay, so Tanner's probably posting it later. But yeah, when I was on the phone with him later today, he doesn't care. He really doesn't care. He truly does not care. I think he said he bought a little bit more Nvidia today, but his argument is going to be the same, which is just that this market is creating multiple compression on names that don't deserve it. And he's convinced of that, which is why he's continuing to buy. Yeah, I mean, I forgot to mention this throughout the entirety of the show today, but Bitcoin is I talked about Tesla and Palantir only being down 5%. Bitcoin, one of the most risk-on assets on the planet, which is a function of liquidity and money supply, is only down 1.2%. Are you kidding me? Bitcoin held better than the indices. It's wild, bro. Absolutely wild. But the fact is, I think Bitcoin and the risk-on parts of the market are also saying, hey, we don't think it's going to be as bad as what the tariff rates are implying. And so that may be a little bit of an indicator on where this market is currently right now. All right, that's it. I shall leave. Thank you, everybody. Hopefully you have a great day. Thank you all for joining. Means a lot. Thank you, everybody, for the support on the Tom Lee interview. I am working behind the scenes to get a lot more of these interviews. Obviously, moving out would be the big catalyst for that because I have my own space. I really want to do them in person, but we're still working behind the scenes to get some other people on the show. There is someone else who's on the list. Probably, I would say, in the next 2 weeks. They'll probably be on the market open or the market close for like 15, 20 minutes. And so, yeah, working really hard to get some more names behind the scenes to join the show. Really appreciate all the support. And the bigger names that we get, the more the show can grow. So I really, really appreciate it. And yeah, if I haven't expressed it enough, I'm very grateful that people watch the show every day. I'm really, really grateful. I'm happy you guys see this as a source of information and obviously entertainment, given the humor that is, just like a byproduct of like me existing, so I just really appreciate that. And I love doing this every day, even if the market is shit, because at the end of the day, if I'm going to lose money, I'd rather lose money with everybody and try to make sense of it. Don't tell me Trump's live right now. Don't freaking tell me Trump is live right now, because then I'm going to be live for another couple. Don't tell me Trump is live right now. Does this guy sleep? Like, what does he do? He's not. There's no way he's live. There's no way he's live. If he's live, we got to watch it, but I don't think he's actually live right now. He's on Air Force One. How is he live? There's no way he's live, dude. There's no way dude, I don't see him live anywhere. All of you guys who were saying he's live, I think you probably misread some tweets or you looked at the wrong tweet. He is not on Fox News. No, he's not on Fox News. Not at all. Yeah, he just talked to people before getting on Air Force One. How would he be live? There's no way. He's not live. He's not live. If he was, I would be there again. CNBC has a live page. Hold on. Let me see. Is that for tomorrow? No, it's not live. Yeah, that was for tomorrow. You might be, for yesterday. You might be looking at yesterday. He's not live right now. Dude, if he was live again, I mean, what more is he going to say? He already messed up everything. What more is he going to say? All right. Thank you, everybody. Appreciate you guys. I'll see you guys tomorrow on The Market Open. Bye, everyone. Love you all. See you guys tomorrow.